be a bit lower than that. So between 3 and 4% is the trend rate of what is sustainable in China's economy, partly because it's richer, partly because it's got this huge demographic challenge that is mounting with an aging a decline in working age population and aging population, but also because, and most importantly, because we're starting to run into the constraints of China's state-led growth model. It's at the stage of development where the market needs to do more of the work in terms of allocating resource. But actually, over the past several years, we've seen a centralization in that decision-making process away from the market and towards government doing more of that work. So I think with or without zero COVID, 5.5% isn't sustainable. You then isn't achievable. You then layer on everything that's happening with Omicron and zero COVID, and I think it makes it even more challenging.
But at the same time, Neil, you also have policy that is getting easier on the monetary side in China, whereas it's tightening for a lot of other central banks around the world. How do you think about that divergence?
Well, and the other point with policy in China is it's something of a black box. Monetary policy doesn't work in quite the same way that it does in the US and in Europe. I think what we'll see is, and indeed we are starting to see the first signs of this, is as policy is loosened, things like property sales starting to bottom out and recover. The question, though, I think, is what happens on the construction side. We've seen this big overhang of construction and unsold properties in China. I think there's a legacy of overconstruction and overinvestment, and it's going to take a long time to work through that. So I think we see some recovery in property sales this year, but construction in particular is going to remain extremely weak. And there might be a bit of an improvement in consumer credit. We've seen some data on that again today. But I think, frankly, it's going to be quite difficult to move the needle on the Chinese economy over the coming months.
Neil Sherring, thank you so much. And of course, we're following Shanghai and occur, and I went back and forth with in Hong Kong this morning, folks, or I should say in his evening, and it is sport in Shanghai, to say the least. I think we need to do a banner on radio. It's so important. I'm going to describe it. Lisa, we need to do the scope and scale of the 10-year real yield. Someone like Jeff Yu at BNY Mellon says this is what matters. From a ginormous, that's CFA talk, folks, from a ginormous negative 1.19, look where we were moments ago, negative 0.13%.
And frankly, earlier this morning, it was even higher. I'm thinking higher, lower. It was even higher, given the fact.
Less negative.
Honestly, it's still negative. But this is the shocking thing, Tom. I mean, yes, the pace of the increase has been dramatic. But could you believe that we're still talking about negative real rates, basically incredibly accommodative conditions at a time when we're going to get a CPI print of 8.4%. Right. So it makes sense for there to be zero real rates or even positive real rates. I keep going back, though, to something that Lee Farage said of State Street. He said when you start getting more positive real yields or even positive at all real yields, it starts to crimp the relative value argument of stocks. And is that what we're seeing, right? Has that been priced in? And that's been some of the mystery that we've seen underscoring the market action. This is what I'm watching right now.
And Kaylee, what's so important here is the German 2 years have gone to a positive statistic. I'm sorry, Kaylee, the behavior of corporations, the behavior, the incentives of central banks all change, moving from negative to positive. We've never done this before.
Yeah, and especially for those companies that enjoy richer valuations, Tom. Technology in particular, you're seeing that reflected in NASDAQ 100 futures, which once again are underperforming today. And as we are drumbeating to earnings season, which really kicks off in earnest on Wednesday, are strong fundamentals, the ability to exercise pricing power, going to be enough as you have real yields looking like they may enter positive territory in the near term? And for so long, that has been one of the components that has upheld the bull thesis. How much does that have to change if and when we see that?
Lisa, travel update. It's April 11-ish. They open the restaurant that John Farrow cares about. Lido del Ferro, which is out by the lighthouse on Capri, closed from October to April 10th. It's like opening day in baseball. Amory Horton's watching the Yankees. Farrow's at Lido del Ferro.
Okay,
How about that?
I love it that, he leaves and he always complains about the fact that we disclose his every move. And now we're going to just put a map up there and be like, he's right here. He's eating in this table.
He's got a chip in his shoulder. It's not a chip on his shoulder. It's a chip in his shoulder as well. Safe travels, John Farrell. Capri looks awfully good this morning. Coming up, Marilyn Watson, head of global fundamental fixed income strategy at BlackRock. Good morning.
Keeping you up to date with news from around the world. With the first word, I'm Ritika Gupta. In France, President Emmanuel Macron's team is painting nationalist Marine Le Pen as an ally of Vladimir Putin. Macron and Le Pen will square off April 24th in a runoff election. They were the top two vote getters in Sunday's first round. Le Pen has been playing down her previous support for Putin. 3 polls show Macron with an 8-point lead. The World Bank says Russia's invasion of Ukraine will cause the Ukrainian economy to shrink by 45% this year. Meanwhile, the Russian economy will contract by more than 11%. The World Bank acknowledges that its estimates are subject to considerable uncertainty. In Pakistan, lawmakers are set to choose opposition leader Shehbaz Sharif as the next prime minister. Sharif will replace former cricket star Imran Khan, who was ousted after 4 years. Khan has called his ouster a US-backed regime change. He lost a no-confidence vote after a fallout with Pakistan's army over a range of issues. Shares of cybersecurity company Cellpoint are soaring. According to the Financial Times, private equity firm Thoma Bravo has agreed to buy the company in a deal valued at more than $6.9 billion. That represents a 32% premium to Cellpoint's closing price on Friday. And in golf, Scottie Scheffler is the new Masters champion. He won the tournament by 3 shots over Rory McIlroy. Scheffler's won 4 of the last 6 tournaments that he's played. Meanwhile, Tiger Woods finished 23 shots back. It was his first tournament since a car accident that almost cost him his right leg. At times, he used a golf club like a cane for support. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its 2 biggest billionaires.
what's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Bloomberg surveillance, there is a view that it is a time of autocracy, and maybe we saw that with the stridency of Le Pen, the vote in France over the weekend. In Hungary, we saw that a week or two ago, the stunning win for Mr. Orban. And here, Mr. Macron, the president of France, fights for his political life. There's no other way to put it. For those of you in America on radio, on television, it's simple. There's a first vote, which is literally like a primary in America, and then it's head-to-head here in a number of weeks. Macron, Le Pen, and Mr. Macron is out today on the streets of France. Caroline Conan knows this. She is overlooking the Eiffel Tower. I can't pronounce the boulevard she's on, but she knows that. That's why she's here. Caroline, tell me about Mr. Macron's need to campaign right now. What's his number one to do to defeat the right and Le Pen?
As you just saw, he's already hitting the campaign trail in the north of France. Today, this is actually a region where most of the votes went to the rival far-right Marine Le Pen. So he needs to hit the campaign trail, something he hasn't been able to do because he was too busy on the diplomatic front dealing with the war in Ukraine. Meanwhile, Marine Le Pen has been campaigning on the grounds locally, meeting with the French, talking to them about the issue of inflation, of purchasing power. This is how she has managed to gain so much ground in this first round.
Caroline Conan, what is absolutely stunning to me, with an understanding of the Fifth Republic, what Charles de Gaulle invented, and I think of Fillon and the others, of the center right. They barely exist anymore with Percusse's 5% vote that she got. 5% for basically the party of de Gaulle. How does Macron get them to turn out to vote for him?
The traditional right wing and the traditional left wing, the Republicans and the Socialists, Tom, have provided in France every single president since 1958 up until 2017 when Emmanuel Macron was elected in the first place. And as you mentioned, this time around the Republican candidate Valérie Pécresse did less than 5%, which is historical. And in fact, that means, because it's below 5%, that she's not even going to get her campaign financed by the state, because she will have to pay back everything that she spent during this campaign. Clearly, Emmanuel Macron has managed to really grab all those center-right voters, but for this runoff, he will also need to go and get the hard left-wing voters and the center-left voters, because if they stay at home in the runoff, then Marine Le Pen has a good chance of being elected.
When you step back and take a look at this election, one of the reasons why so many people are watching it and concerned about it is because a much greater proportion of the French public have been voting on the fringes. If you take a look at the turnout, which was actually lower than a lot of people expected. And frankly, Marine Le Pen right now is trying to be cast, at least in Macron's view, as being pro-Vladimir Putin, pro-Russia, pro-Kremlin, a sort of Trumpian kind of version in France. How effective is this? How much does the average France individual really make any difference, or does this matter to them, given the fact that their primary concern is cost of living?
You're totally right. Today, the offensive from Macron supporters is clearly about Russia and Vladimir Putin. Like, Marine Le Pen is being portrayed as a Putin ally. And back in 2017, she actually met with Vladimir Putin during the campaign, and she had a loan from a Russian bank. Of course, with the war in Ukraine, she has been trying to distance herself from Vladimir Putin. But the French, ironically, have not really paid attention to this proximity, to this sympathy, it seems, with Russia. Perhaps this is something, an angle of attack that Macron supporters will have between those two rounds, and also during the debate on April 20 next week, just 4 days before the runoff. That will be key.
And honestly, Kayleigh, this is the reason why so many people have been watching this election, because, frankly, people were worried about a Marine Le Pen victory and what that would do to NATO and the whole support for the Western order that people are trying to reprise, at least over the past few months.
Yeah, absolutely. And that threat, as we know and understand, is not yet over. There's still about 2-3 weeks to go until April 24th, and a lot can change, as we know, in a very short time within election cycles. Caroline, we were talking about where the votes for those candidates that did not make it to the runoff will go. What about Jean-Luc Mélenchon? 22% of voters voted for him, yet he did not endorse Macron. He just said, don't vote for Le Pen. Where does that leave us?
In fact, Jean-Luc Mélenchon's electorate, so these hard-left voters, will be crucial for this runoff, because 22% of the votes in the first round, that's very high, that's better than what he did last time around. If we look at the polls, about 1/3 of Mélenchon's electorate is planning to vote for Macron in the runoff, but about 1/3 is also planning to vote for Marine Le Pen, and the rest would abstain. And Jean-Luc Mélenchon didn't officially endorse Emmanuel Macron for this runoff. So Marine Le Pen, in order to be elected, she would actually need to grab some of Mélenchon's voters. She would need to obviously get all the electorate of Éric Zemmour, this far-right pundit who's actually made her appear more mainstream, more normal, less scary in this election. And she would also need the center-left voters to stay home for this runoff.
So it's about, Caroline, this is really important. It's about turnout, right?
It is about turnout, and in fact, the turnout last night was not as high as in 2002. Remember, that's when Jean-Marie Le Pen, Marine Le Pen's father, unexpectedly made it to the runoff. So the turnout was not as bad as in 2002, but still it was lower than last time around. And if abstention is very high in the runoff, this is not going to help the incumbent Emmanuel Macron.
Caroline Conan, thank you so much from Paris this morning. Lisa, I look at this and I look at Euro-Yen as a litmus paper of the global system. That's always true, but particularly here with weak yen, 125, maybe we get to 126. But look at Euro, Lisa, with a stronger Macron move.
Frankly, there was a pop across all comparative currencies, both the yen as well as the dollar for the euro, and this is a sense of relief because it was also the margin was wider. Macron winning the latest election by a bigger margin than a lot of people expected. Honestly, Tom, I mean, this is an outlier chance, right? Most people, when you talk to them, think that there's not really a chance that Marine Le Pen is going to be victorious, but there does seem to be a much bigger chance than there had been in the past. And frankly, you're seeing that play out in the euro in a pretty significant way.
And Kayleigh and Lisa, this underscores our need to be in Paris for the election here.
Keep making the case, Tom. Didn't you just get back from Paris?
Well, yeah, but, you know, we can always do it again.
Tom needs more croissants.
Euro-yen, strong euro, weak yen. One of the moves this morning, the real move in the 10-year, 2.76. 2.76, up 6 basis points. And the 10-year yield, Lisa and I are on the watch. Wow, the 10-year real yield, negative 0.12 is the handle. Stay with us on radio and television. This is Bloomberg.
of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Part of the reason why growth is going to be slower is that the Fed is trying to slow things down.
The Fed seems to be a little bit more concerned about inflation than I would have anticipated.
There's a real concern right now about a slowdown that is consumer-led.
Demand needs to be slow. It's simple supply and demand here, right?
I don't think the market has quite made up its mind whether it's going to be a recession or just, quote-unquote, a growth recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Mr. Farrow on well-deserved sabbatical. Kaylee Lyons doing double duty this morning. Kaylee, thank you for joining us this morning. Again on radio and TV. And I really want to emphasize with the news flow, the inflation report tomorrow, our trip to Washington scheduled for Thursday with Ms. Georgieva of the IMF. You know what, Lisa? The markets matter, and they are moving.
They're moving, and it's not just the IMF that we're going to be at on Thursday. We also have the ECB meeting, which is going to be interesting because markets are moving around the world. We're seeing it definitely in the 10-year yield today in the United States, with it reaching the highest levels since the heart of the pandemic. But it's also German yields. I mean, honestly, they're the highest since 2015, Tom, just to put into perspective how significant this move is. At one point, we were talking about negative yields in Germany on the 10-year early in March, and now we're talking about almost 0.8%.
I'm not going to sit on a data check right now. We'll do that in a bit here, but I'm sorry. The 10-year real yield is front and center this morning, negative 0.14. Wow, have we come to a smaller negative statistic?
And honestly, is this because of the balance sheet discussion that we got in the minutes? Why the sudden move? What do you think is driving it? And honestly, if you take a look at oil prices, they've actually come down because of concerns about the slowdown in China and the lockdowns in places like Shanghai. What's driving this latest leg up? Is it technical? Is it just people capitulating? And I think that really the answer to that will drive how much further it has to go.
The rate of change here is really critical. And Kaylee, part of this is the rate of change of our international relations. Maria Tadeo in Luxembourg with foreign ministers, Anne-Marie Horton in Washington, and it is a movable feast all focused on the war in Ukraine.
A war in Ukraine that continues to intensify as Ukraine is now warning of Russia reinforcing its position in the east, really fighting for the east after moving out of part of the north of the country. And it raises the question of the Western response. Obviously, Ukraine has asked for more weapons. The West says they will deliver. But on the sanctions front, how much are we running out of cards to play? Europe obviously yet to play the gas card. But of course, that is a conversation that they are still having in Luxembourg and beyond.
The tensions on oil sanctions, and also Mr. Biden to meet with Mr. Modi by Zoom. Yeah. I guess Zoom today. They're tuning in like everybody else. Maybe it's like presidential Zoom or elite Zoom. I don't know, but they're going to Zoom today. We'll have more on that. Some real tension there, complexities in the India relation. Let me do a data check right now. We want to get Lisa's brief in, and then we've got a wonderful guest on how to reset second quarter, given truly the cacophony that we see right now. Futures, -15 on a stick on the VIX, 22.32. We go up the Dow for John Farrow, -13, 34,600 on the Dow. Let's call that 1,500 points away from Nirvana. The yield is the story. 2.57% 10-year, 2.76% 10-year, I should say. 2/10s goes from inversion out to a positive 17 basis points. Oil just under 100 on Brent. Crude as well. And the foreign exchange market speaks volumes with euro on a tear versus yen as well. Lisa?
Yeah. Honestly, Tom, I want to offer up a surveillance clarification, right? We're talking about John as though he's on sabbatical. He's just taking vacation for the week. So anyone who thinks he's off for the next month or something, unless they be confused by Tom's sabbatical talk, just want to clarify that for the record. Today we get a host of Fed speakers who are going to be coming out and talking about how they're going to navigate what is becoming an increasingly tricky moment. Raphael Bostic, Michelle Bowman, and Christopher Waller all speaking at an event at 9:30 a.m. and then Charlie Evans of the Chicago Fed speaking at a separate event in Detroit at 12:40 p.m. How much will they talk about that move in real yields, as Tom was talking about? The fact that we're nearly 11 basis points away from zero. Yes, we're still negative, which is really shocking considering how high the inflation is. The expectation for 8.5% inflation tomorrow with that CPI. How much does this actually give them some hope that they're being effective when they haven't raised rates by that much? And frankly, they have not started rolling off the balance sheet. We talk about the balance sheet as though this is something massive, which it will be. However, we are still at $9 trillion. This has not begun. Today, Austria's chancellor is going to visit Vladimir Putin in Moscow. He put this out on Twitter earlier. Even though this is a neutral country, they're talking about how they are concerned about the humanitarian crisis in Ukraine. How much does this really shift to a more aggressive stance by a lot of European nations?
Lisa, this is important because Austria's got huge weight of Russian energy. This is a real nuanced change.
Especially given the fact that they continue to buy oil and gas, and this is one of the main points of contention among the foreign ministers who are meeting in Luxembourg today. 11 a.m., we were talking about this earlier, both Kaylee and Tom. President Biden is meeting virtually on Zoom, as Tom just informed us, maybe, with Indian Prime Minister Narendra Modi. How much is there increased pressure, Tom, to really get some of the quiet allies, are they allies, to really speak up and declare which side they're on, given the fact that we have not heard anything decisive and aggressive out of India, basically castigating Russia for their war in Ukraine?
I'll try to get this story out on Twitter, folks. Sudhi Ranjan Sen, reporting from India for Bloomberg News, really lays out beautifully the nuances here of China and India and the United States, and then India and Russia as well. There's a real complexity to this story. Right now, in the complexities of all the economic babble we talk about, and what does it mean actually to construct strategy? Tom Kennedy joins us right now, Chief Investment Strategist at JP Morgan Private Bank, and we're thrilled he could join us this morning. How do you take the cacophony right now and distill down to the new short term for long-term money? How far out is short term for JP Morgan Private Bank?
Good morning. Short term for us, Tom, is probably 3 to 6 months. And over that period, we're most concerned about the Fed's dual movement at the They have, on the one hand, a very tight labor market that makes it hard to believe that core inflation can roll over in the near term. And then they also have, on the inflation side, persistently high inflation that calls into question if inflation fighting credibility is at risk here and if true entrenchment is here. So that 3 to 6 month period, Tom, looks like a Fed that has to fight the world from the top side, inflation from the top side. And that's the first thing the first time they've really had to do that in many, many decades.
Tom, on Wednesday, we get earnings kicking off with your bank. I understand that you probably are not involved with drafting those. However, it's going to be a very awkward moment for all of these companies as they deliver potentially really good earnings, and frankly, for the Federal Reserve. If they surprise to the upside with respect to margins that hold in, what does the Fed do?
Yeah, Lisa, the question on margins is important because you have the ability to pass on, which is good for corporate earnings, but from a challenge for the Fed, who really needs to slow demand. The real question we're all asking, Lisa, you hit it on the setup, is how high do rates really need to go to slow down this economy? And assuming inflation expectations can remain anchored, we really should start to question if that's happening right now. You can look at market internals, yes. Three things you can really look at. Market internals so far, yes, the index level is still near historic highs, but financials performing poorly, housing performing poorly, so already cyclical slowdown. Next, you can just look to the bond market, Lisa. The market's pricing that the Fed will get to 3.25% next year, and that for the next 10 years, they'll stay at 2.5%. It's a very optimistic price. And then lastly, look to the housing market, the most cyclical piece of the U.S. economy. The average American walks into a bank right now, they're going to get a 30-year mortgage north of 5%. That's almost 2 percentage points higher than what's existing in the market now. So this is, to me, the most important question.
Well, Tom, you mentioned how high rates need to go to really cool off the U.S. economy. Let's talk about how high yields need to go to cool down the equity market in a more material way. We're just 13 basis points into negative territory on the 10-year real yield. If and when it goes positive, is Tina dead?
I don't think so, Kaylee. I don't think there's anything magical about the negative interest rate conversation. Real rates should continue to go higher. I tend to focus mostly on the five-year. So 5-year rates starting in 5 years forward. Those real rates are already positive. The problem for the Fed is that inflation expectations out that far are still very high. So this conversation about peak hawkishness from the Fed, number one, needs to see spot inflation roll over before we can really think that that has happened. And we really need to start to see five-year inflation expectations roll over so that inflation fighting credibility remains intact.
Very good. Tom Kennedy, thank you so much with JP Morgan Private Bank. Lisa, we really haven't touched on it today, but Mr. Musk, I guess, isn't joining the Twitter board, the soap opera.
It's just hilarious. After proposing that they turn their headquarters into a homeless shelter, and people weren't exactly sure whether he was serious or not, and Twitter took it as on its face value and basically said it's a great idea. But honestly, what does he want from this involvement? He said he was going to take a passive stake, right? He took this 9% stake. Then Twitter offers him a seat on the board, saying we value your opinion, trying to get ahead of him so that he wasn't the enemy from outside. He was the enemy from within, and he rejected that. So what's he going to do with the stake?
Yeah.
I'm speechless, Kaylee. Help me here. Those of us older say, why does he have a different rule book than everybody else? I don't get it.
Well, I don't know if anyone knows the answer to that question, Tom. He is the richest man in the world, though, so you have to keep that in mind. But to Lisa's point about what he goes going forward.
I don't agree
on
with Kaylee, I do not agree with that. Going back to Securities and Exchange Act of 1934 and 1933 is, well, if we had that attitude back then, we'd still be in the Depression. I do not agree.
But on the point of the SEC, it does raise a question of whether or not there would be some kind of regulatory headwind for Elon Musk being on the board of Twitter and owning such a large stake in it. Remember, if he joined the board, he was going to be capped at 14.9%. If he's not on the board, that's no longer the case, and it raises some speculation if he's thinking about potentially more active stake or an outright acquisition, Tom.
Kaylee Lines up to speed on what I don't want to be up to speed on.
Acquisition? How does that fit into, I mean, what, you go to space and you can also tweet?
Yeah, I don't know. I mean, he's got his own rule book. That's what I know for certain. We're going to continue. Stay with us. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Ukraine's President Volodymyr Zelensky expects Russia to turn to even more large-scale action this week in the eastern part of the country. He has been warning for days of a new Russian offensive. Zelensky told CBS he understands there will be much more Russian weaponry than there is now. And it is another twist, as the actors just talking about in this week-long saga of Twitter and Elon Musk. Twitter says the world's richest person has decided not to join its board. That touched off renewed speculation after the company's future. Musk owns just over 9% of Twitter stock. If he doesn't join the board, Musk wouldn't be subject to an agreement to keep his stake at no more than 14.9%. And in France, President Emmanuel Macron and nationalist Marine Le Pen are headed for a runoff in the presidential election. It's a rerun of their 2017 contest that will reverberate across Europe. Macron received 27.6% of the vote in Sunday's first round, compared with 23.4% for Le Pen. The runoff will be April 24th. 3 polls show Macron leading Le Pen 54-46. Iran says the 2015 nuclear deal is alive but lingering in the, quote, emergency room. A government spokesman says the deal's fate is resting on a decision by the U.S. on Iran's latest proposal. One of the issues is the Trump era's designation of Iran's Islamic Revolutionary Guard Corps as a terrorist group. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Bloomberg has enhanced search on the terminal.
to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
The war in Ukraine rages on.
President Putin's invasion is brutal.
Turn to Bloomberg for up-to-the-minute reporting from around the world and analysis of what it all means to you.
The intention here is to increase the pressure on the sanctions front.
I think the United States policy is that the sanctions continue until President Putin is no longer there.
For continuing coverage from Ukraine and around the world, keep it tuned to Bloomberg Television and Radio.
We have the feeling that President Putin is throwing all his might into the east of the country, and we cannot leave any stone unturned to end this humanitarian disaster and to make him understand that he's isolating Russia, that this war is a war that he cannot win morally. He has lost it already.
An important voice, an important meeting. Schallenberg of Austria, the foreign minister Alexander Schallenberg there in meetings with Putin, and this is going to be a big deal. Austria is neutral, but it's not, but it's got a huge energy component from Russia as well. Maria Tadeo touching on that in the last half hour. Maria Tadeo with us in Luxembourg. And in Washington, waiting at the White House for a Zoom meeting, Anne-Marie Horton. Anne-Marie, get out the map. And India is miles from Moscow, but it's not. Because it doesn't border, but it touches upon the stands. Yes, Afghanistan, but far more Tajikistan and Kyrgyzstan. Mr. Putin cares about the stands, doesn't he?
Yes, and also obviously Pakistan, which is why India is so crucial to Russia in terms of arms trade. This is where India finds itself getting lots of weaponry, continues to do so. About $10 billion is coming down the pipeline from the weapons New Delhi is sourcing from Moscow. And it's one of the reasons why India is in this difficult position and really walking this fine line out in the public spaces, making sure they are not openly condemning what is going on. You saw what they did last week in abstaining again at the United Nations when the rest of the world wants to revoke Russia out of the UN Human Rights Council. And what you have is an India that is just very reliant on Russia, and also a United States that needs India to also have these weapons to be a counter to China in the region.
And Maria Tadeo, when we were children in America, we played the game Risk, which was the global map and the complexities that children would do. That's what we're living right now. Who's driving the Western bus this morning? Who's the voice in charge of directing the Western response to Mr. Putin?
Well, it's very difficult to say because we don't hear from Olaf Scholz. He's very criticized at the moment for not sending perhaps weapons quickly enough. Mario Draghi is now in Algeria today trying to get a domestic deal for gas. And Emmanuel Macron is now in the midst of a 2-week re-election campaign. So a lot of this shows you, Tom, that yes, the war in Ukraine is a #1 issue at this point, but then there's also the domestic agenda. And this domestic agenda, by the way, is now amplified by the inflation that we're seeing, by the prices that we're seeing, and all of this is coming to bite home. I guess the question at this point, and Mario Draghi was very good with this, he said, we say we're committed to help Ukraine, but we need to figure out how much we're willing to pay for it. Do we want to have air conditioning or do we want to have peace? And I think that's a question that we're seeing reflected in Europe, but we don't have an answer. And there's many voices also distracted by their domestic agenda.
Yeah, and Maria, to build on that, Boris Johnson went and visited Kyiv, and now he's being compared to Winston Churchill. I mean, is this really the reality on the ground in terms of popular support, or is there a lot of pushback? Does this not necessarily play in the same kind of political way at home amid the increasing prices for everything from food to gas?
look, that's a very good point because, of course, at home he's under a lot of difficulties, and we know why. But in Ukraine, Boris Johnson, they love him. They love the fact that he went there. They love the fact that he walked around in the city. They love the language that he uses when he says Vladimir Putin will be defeated. We're going to give the weapons that Ukraine needs so they're able to defend themselves. That moment in which he walks around with Zelensky, this went down in Ukraine very well. That clip of the two, that went viral. And of course, he's very good when it comes to working a crowd. So again, yes, you could look at this as points that he's trying to score at home when there's many issues that are happening. But in Ukraine, I have to say, this moment in which the two were walking around, it went viral and it went down very well.
Well, let's talk about the Russian side, Anne-Marie. There is a new man in charge on the ground in Syria, General Dvornikov. He obviously has been called the butcher of Syria. He's now in charge of operations in Ukraine, and he was known for his history of targeting civilians. The White House, of course, has promised a severe response should the use of chemical or biological weapons come into play. Do we have any more of a sense of what that would actually look like, considering how many cards the administration already has played?
We don't. When the president is asked about what exactly are these severe consequences look like, he says that they're not going to communicate that out in the public. When I was at the NATO headquarters, though, and I spoke to the Latvian president, he said that leaders did discuss what those consequences would be. And at the moment, he thought maybe they should broadcast that to the Kremlin, but at the moment, there wasn't going to be such a strategy. When you're looking at this new general, Alexander Dvornikov, yes, he's been called the butcher of Syria. He was leading the Russian army when they decided to enter the war. He really turned the tide for Assad. Not only that, before he was now this new general under one command of what is going on in Ukraine, his focus for Russia was always eastern and southern Ukraine. So this is an area he knows very well, and he is already regarded in Russia as a hero. He was called a Russian Federation hero after his work in Syria. What the United States says over the weekend, we heard from Jen Psaki, the press secretary, we heard from the president's national security advisor, Jake Sullivan. They said we can expect more of the same, which is likely going to be meaning the targeting of civilians.
Emery Harden, thank you so much. Really important call there between Mr. Biden and Mr. Modi. Maria Tadeo on the watch in Luxembourg as well. Thank you as well. I want to turn back to the markets. We've been focused on yield. There's no question about that. 2.76% is the headline statistic today, the 10-year yield. But Lisa, Mike Wilson, the weekend reading, I thought Morgan Stanley was something with a 4.6% earnings growth, and he just flat out comes out and says growth will disappoint.
Yeah, growth's going to disappoint given the fact that inflation's going to eat into margins. And frankly, he's been a pretty big bear, right? So we're looking at the bearish side of the equation. Not that I would have any proclivity to do that, but you know, certainly you're seeing a feeling of that in the market today. I keep going back, though, is the bigger story potentially earnings? And if there's a disappointment, is that really going to be such bad news? Or is the story really the Fed? Because what we're seeing today is that move in yields, and that seems to be what's hitting the equity markets, and frankly, what you're seeing, particularly in big tech stocks that are more interest rate sensitive.
And I look, Kaylee, at Michael Feroli's J.P. Morgan note Friday evening, and he talks about the wedge in what we look at for inflation. There's 14 ways to look at inflation. I'm going to just suggest, would everybody get over it? The answer is higher.
Well, yeah, and when you look at the components of inflation, wages is something that Mike Wilson also has brought up, because when we talk about companies that need to pass on higher costs, among those higher costs are labor costs, having to pay employees more. And when we talk about the potential of a wage price spiral, Lisa has a thought on that.
Well, no, but honestly, I mean, this is a good thing,
Kaylee.
right? No, but this is, to me, I mean, honestly, Kaylee, Tom, isn't it good? Don't we want to see wages go up, right? I mean, at what point is it negative? If they don't go up quickly enough, then consumers don't have buying power. I'm just saying, Tom.
You just say you cut off Kaylee at 7:25. Kaylee, feel good about it. She would have cut off Pharaoh at 6:02. This is Bloomberg.
Who's keeping track?
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Bloomberg Surveillance, we say good morning to all of you on the data front. It's simple. We're going to get to this with Marilyn Watson in a moment here. Yields move and move with a vengeance. We leg out on the 10-year yield, 2.75%. Lisa, the inversion is gone. We've got 18 basis points of a positive yield differential between the 10-year and the 2-year. And I'm sorry, the clarion call this morning, Lisa Bramwitz, is the 10-year real yield.
Absolutely, given the fact that we're at the least negative going back to the heart of the pandemic. But I would say crude. I'm really keeping my eye on crude. The idea that you're getting a 4.3% decline in WTI crude prices really gives you a feeling of all the wrong reasons, right? I mean, the reason why we're seeing a decline is not because the conflict's been resolved in Ukraine. It's because of China and the lockdowns there, Tom. How much do we start to move to this slower growth type of scenario in addition to some of the supply chain disruptions and the higher inflationary forces?
Yeah, I really want to emphasize, folks, within the data check, let me focus on currency right now with S&P futures negative 20. Currency is a resilient dollar near 100 on DXY. Yen is my headline, rounded up to 126 yen. Weaker yen is a huge story this morning, and maybe the Macron effect, the euro at a 109, doing better off of the French election. Right now in the equity market, Kaylee Lines.
Well, Tom, we have to talk about one of the individual corporate stories we're watching this morning, and that is Twitter. The saga continues. It's been about a week now, and it seems like there's a new development every single day. Elon Musk, now an active 9% or so stakeholder in the company, will not be joining the board. And that gives him clearance to build a stake greater than 14.9% if he wants to. So the question becomes, what exactly are his ambitions with this company? Could we realistically maybe be talking about a takeover? Twitter shares, though, off of session lows. They were down as much as 8% in pre-market trading, now off just about 1.7%. And of course, another company in Elon Musk's control, Tesla, it's down 4%, but of course it commands a very, very lofty multiple. And as we have yields moving higher, as you both were just discussing, that puts pressure on some of those growth stocks, including NVIDIA, which is down by about 3%. Double whammy for this stock. It also was cut to neutral over at Baird, 225 price target. It's trading at 224 this morning. And of course, it's not just U.S. stocks lower as well. Chinese stocks were under a lot of pressure in the Asian session. Some of those players that trade here in the U.S., like DD Global, are lower in early hours. It's off by 2.4%. Then more news on share splits. Shopify now doing a 10-for-1 stock split. We know that doesn't really change the fundamentals of the company, and yet it always seems to give a lift to the shares, and that is true here too, up about 1.3%. Final note on Wells Fargo, which we'll be reporting on Thursday, was upgraded to a buy at Citi. It's trading higher by about 1 percentage point as the drumbeat to Wall Street results continues, Tom.
Thank you so much. Greatly appreciate that. Our interview of the day on yield, and it is yield up, and it is decidedly priced down. Marilyn Watson is head of global fundamental fixed income strategy at BlackRock and has a wonderful view of this strange idea of it's not just about yield, it's about price as well. Marilyn, I just took the age 15 10-year series back to the time of Volcker, and we had lower yields and higher prices of 5 standard deviations in the pandemic scare to low yields. We've reversed, and we are up, but up only 1 standard deviation off that long-term great moderation. Can you and BlackRock say that the great moderation is over?
I don't think that yet we can say that the great moderation is necessarily over. I think what we're seeing now is we are in this period of correction, having had incredibly suppressed yields for going back several years now, and then exacerbated during, obviously, the pandemic. So I think what we're really seeing now is an increase in volatility as the market really is positioning itself for the Fed to be more aggressive in terms of quantitative tightening, both in terms of raising interest rates and also the runoff in the balance sheet that potentially will come maybe in May or in June. And I think as we do start to see the Fed really start to shift away and try to move towards a neutral point, then it's understandable that we're seeing a lot more volatility in the market. I think it's also incredibly important when we continue to look at inflation, just how high it is in the US and elsewhere around the world. And as you mentioned before, there are a number of factors that are really exacerbating this, whether it be the lockdown in China, in Shanghai, due to COVID restrictions, whether it's energy and the massive impact that that's having in Europe in particular, for example. So I think there are a whole confluence of factors that are really, exacerbating the volatility in yields and the market's expectation of what we can see from interest rates, from the Fed, and also from the ECB as well as we go forward this year.
Marilyn, earlier this morning, Tom Kennedy of JP Morgan, a private bank, asked a really good question. How high do yields have to go to restrain inflation? What's your view on that?
Yeah, I mean, so at the moment, we do think that rates could go definitely a bit higher from here. It is our view that inflation will probably start to roll over pretty soon. It is obviously at very high levels, but given base effects and other things that will sort of come into play, we do think that inflation will start to tick down, but obviously from very incredibly high levels. I think that's why the Fed has indicated it will be more aggressive. I think that's also why the ECB has started to signal that it's maybe potentially ending its asset purchase program, maybe in the July, the third quarter of this year, and it's teed itself up to potentially raise rates as well by the end of this year. So I do think that rates could go higher. I think it definitely go higher from here. But we also do need to keep a firm eye on inflation, and I think there the risks are huge. As I mentioned, there are risks in terms of pushing inflation higher. If we start to see issues around as I said, the restrictions in China, energy, elsewhere, or we could start to see inflation actually roll over. And the other part of the equation, of course, is growth. There's a large risk now around the growth in the Eurozone. I think that's certainly a factor that was come into play as we look at what the ECB may do later in this year. But also when you look at the US as well, I think growth, remains relatively strong. The labour market is incredibly tight. And we're also, continuing to see the consumer and the high level of household savings that they still have. They're starting to run those down as they still continue to purchase. We see retail sales and other things. And it really depends whether we see a shift in sentiment, like how much further that has to go. But for the time being, I think growth remains relatively solid in the US. And really, inflation and inflation data is absolutely critical now.
So in the wall of worry, Marilyn, that you talked about, of the potential increase in inflation, potential slowdown in growth, what do you do? How much do you lean into a risk at a time when people already are somewhat bearish? I would just say people. I'm not going to specify who.
So at the moment, we have been short duration. Now we're relatively, I would say, neutral. We still have relatively low duration. But I think now, given that the risks are two-sided, we are being very flexible. We now are starting to get a little bit more carry in front-end rates. So we're starting to just invest a little bit more there. We do like some areas of securitized, investment grade, and we are looking to be very, very diversified. That being said, of course, we are still relatively conservative at the moment. I think the next 2 months, when we see further inflation data, further data around growth, we see developments ongoing around the situation in Ukraine, the impact of sanctions. So I think there's a lot that still needs to be factored in, and that we really need to see evidence either way of how things are starting to shape out. But I think there are areas now where we can see value, where we are starting to get some yield. And I think diversification is really the name of the game, but also really, really understanding liquidity and the risk reward and the liquidity around each position that we currently hold.
Marilyn, you talked there about some geopolitical risk factors that need to be put into the equation. What about domestic politics? I'm thinking specifically of France here. I'm looking at a 10-year yield that started March around 40 basis points. We're now in and around 129. What would happen to the French bond market if Marine Le Pen were to win the runoff on April 24th?
So we have seen, as you mentioned, a lot of volatility also around France, around the potential election. And the market is clearly signaling that it's positioning itself for, it has a preference for, in the market, in the euro, in terms of keeping much of the same. So Macron obviously staying in power. It does remain to be seen, and we have this runoff on the 24th of April, and I think we will start to see a lot of volatility around that event. If Le Pen does win, I think it's too hard to say at the moment. I mean, she has really been quite clear, I think, around some of her economic policies. And I think it really remains to be seen if she were to get into power what her, the policies that she actually implements would be. I do think it's maybe a little case of sort of just trading around this volatility, sort of like, buying the rumor, sell the fact, potentially as well. So I think for the time being, it's more around the potential trade-off between the two candidates. But in either scenario, it really remains to be seen what policies would be implemented.
Marilyn, thank you so much. Marilyn Watson there of BlackRock. Lisa, a really important thing, and this is how economists look at yield. I took what's called the H15 series, which goes back 70 years, and the move up here to 2.75% is possibly the greatest standard deviation move higher during the Great Moderation, which means it's really a test of where we are in the move from Volcker, the 40-year move of this Great Moderation.
How much can we look at a new higher yielding regime when we talk about yields that are still only at the highest since 2019, but really edging up to some of the Great Moderation highs that we've seen? We were talking, remember we were saying that yields couldn't go that high because something would break because of all the debt that had been incurred. No one's talking about that. And to your point, Tom, a lot of this has to do with a lot of the momentum, a lot of the strength in the economy that people had perhaps not expected in the past.
And Kaylee, I want to go to your Wells Fargo comment in the stock report, the idea of some people still enthused by the banks, even though there's gloom of recession.
Yeah, and of course, we'll see how much that bull case really holds up when we start to get earnings. JP Morgan kicking us off on Wednesday, Tom. What's interesting here is Citi saying that Wells Fargo's balance sheet stands out among the U.S. banks in particular.
Interesting.
Fair to note, though, that Citi also has a buy rating on all of the other financials for the most part, including JP Morgan and the like. The flatter curve, though, also not as much a problem in recent days for these banks, Tom.
Deep into 2022, April, feels like November. It's been that kind of year. On his France and his definitive, The History of Modern France, we are thrilled to bring you Jonathan Fenby. We'll do that soon. On radio and television, this is Bloomberg Futures, -26.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. In France, President Emmanuel Macron's team is painting nationalist Marine Le Pen as an ally of Vladimir Putin. Macron and Le Pen will square off at April 24th in a runoff election. They were the top two vote getters in Sunday's first round. Le Pen has been playing down her previous support for Putin. 3 polls show Macron with an 8-point lead. The World Bank says Russia's invasion of Ukraine will cause the Ukrainian economy to shrink by 45% this year. Meanwhile, the Russian economy will contract more by than 11%. The World Bank acknowledges that its estimates are subject to considerable uncertainty. In Pakistan, lawmakers are set to choose opposition leader Shehbaz Sharif as the next prime minister. Sharif will replace former cricket star Imran Khan, who was ousted after 4 years. Khan has called his ouster a US-backed regime change. He lost a no-confidence vote after a fallout with Pakistan's army over a range of issues. In China, port congestion has gotten worse in Shanghai and posed a coronavirus lockdown. There are 477 bulk cargo ships waiting to deliver everything from metal to grain. The lockdown led to warehouse closures and a trucker shortage in Shanghai. That led ship owners to divert ships to other Chinese ports. And in golf, Scottie Scheffler is the new Masters champion. He won the tournament by 3 shots over Rory McIlroy. Scheffler has won 4 of the last 6 tournaments that he's played. Meanwhile, Tiger Woods finished 23 shots back. It was his first tournament since a car accident that almost cost him his right leg. At times, he used a golf club like a cane for support. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Sanctions are always on the table. Discussing about Ukraine means certainly to discuss about the effectiveness of our sanctions. The one has already been decided, and certainly ministers will discuss about which are the further steps.
The Vice President of the European Commission, Josep Borrell, there is the message is managed forward. Our Maria Tadeo in Luxembourg this morning for ministers' meetings. And again, we will remind you of Mr. Biden and Mr. Modi in a interesting, delicate phone call. They'll do that digitally here today on the war in Ukraine. We're following the headlines from Russia. It's been a quiet morning, all in all. On that front. In the markets, Lisa, 2.75% 10-year yield. That says all, doesn't it?
Especially because it's actually reverting to that trend that we saw for a minute where when yields rise, tech stocks sell off. People are definitely getting concerned as we move closer to positive real yields, what that means for risk appetite. I mean, Kaylee asked the question earlier, is Tina dead? There is no alternative once you get positive yields. People saying not necessarily, but it raises that as a potential issue.
Kaylee Lyons in for Jonathan Farrow this morning. This is a true joy. He is a prolific writer on Chiang Kai-shek. He is a writer on France, is definitive. The History of Modern France is an important read. I've read it cover to cover. But also a one volume on what there was before Macron, before Le Pen. And that is, of course, his magisterial book on General de Gaulle. It can only be Jonathan Fenby. Jonathan, thank you so much for joining us. Can you explain the collapse of the center in the right around the 39-year-old maverick, Mr. Macron, in his second term? What de Gaulle wrought seems to be politically destroyed. Is it?
Well, the conventional center-left, center-right division on which the Fifth Republic has rested, really, for the last 50 years or more, is now destroyed. Macron took away a lot of the support from the socialists last time round, and this time he seems to have taken away a lot of support from the center-right Republicans. Add to that the rise of Le Pen and other extremists on both left and right. And France's politics have become completely fragmented.
In the tumult of America, there was a massive turnout in the last election. Mr. Trump, of course, notes 74 million people chose to vote for Trump. Tell us the mystery of this turnout, April 24th.
Well, the question now is how many of the people who voted for the hard left-wing candidate, Jean-Luc Mélenchon, and there were 22% went for him, which was an unusually high, an unexpectedly high number. How many of those who don't like Macron, will still hold their noses and vote for him, or how many will abstain? And it's really in that equation that probably the outcome of the runoff on the 24th will be decided.
Jonathan, how much is the move toward Marine Le Pen indicative of this shift away from the Western order, something that we saw with the Trump presidency and certainly that we've seen on the margins in a number of nations?
It is in part that, but the even harder right candidate, Eric Zemmour, who played the values card much more strongly than Le Pen, he didn't do as well as many people thought he might have done. And Le Pen really picked up a lot of votes yesterday on cost of living issues, security, law and order, all these kind of grassroots issues, which she made the center of her campaign.
And what does Emmanuel Macron need to do as he campaigns between now and April 24th? What is his largest task?
His largest task is to show that he cares for the French people. His opponents made the argument going into the first round that he was too obsessed with his position as an international statesman, having once described the president as Jupiter-like, that he floated above everyday concerns. And he's got to show the French that he cares for them.
John, I'm absolutely fascinated by this, and folks, this is very different than America. Paris is roughly 31% of the GDP of France. I mean, it's Paris-centric. Is this, John, just simply, as a generalization, Paris and Macron against the nation of the rest of France?
That is certainly the way Le Pen will try to pitch it, I think, for the second round. You're a metropolitan elitist who cares for the world, the upper elite class, looking after them, the president of the rich, and you've got the rest of France, which is being left in the doldrums. And that's really been her main campaign theme.
Okay, but John, here's the issue. To our viewers in radio and TV, their view of France, as you well know, is table 12, table 12 at Eau Petite France, Eau Petite Suisse, overlooking the Luxembourg Garden. I mean, you sit there in the sun and everything's great. That's not France. Is that what France is saying to Macron? You're not France?
Absolutely, Tom. You've got it absolutely right there. The rest of France, those who voted for Le Pen and for Mélenchon, and I emphasize again that he got 22% of the vote, although he finished third, they're basically telling Macron, look, France doesn't just exist in the smart parts of Paris. It exists in rundown towns and suburbs and deserted farmlands, and you've got to start paying some attention to us.
How much popular support is there within France, Jonathan, for France's approach to Russia, to what's going on in Ukraine?
Well, Ukraine, in a sense, has been, it's been there all through the campaign, but Macron's conversations with Putin, I don't think did him any harm because he was seen as putting France on the world stage. On the other hand, the far left and far right candidates who'd palled up to Putin earlier on are somewhat embarrassed by this, and Macron will make a lot of their closeness, Le Pen's big loan from a Russian bank, for instance. A lot of that will come up in the campaigning for the second round.
Jonathan Fenby, thank you so much. Greatly appreciate it. Wonderful to catch up with you again. And folks, I can't say enough about Mr. Fenby's commitment to writing of France. There have been other great books on France, great volumes on de Gaulle, but Fenby is the one who over the years has just put together truly thousands of pages on this interesting nation. I'm looking, Lisa, here at this little cafe. It overlooks the garden, and it's out of, like film a movie, do a Spielberg movie there. It's that simple. And that's all we in America see. Ugly Americans, that's all we see.
Film a Spielberg movie, film surveillance.
Yeah, really.
I feel like you literally do like Duolingo in the breaks.
Oh, no.
Frankly, while we're on air in order to
that.
prepare for a potential road
you
trip.
You mean La Vue du Puy au Petit Suisse?
Honestly,
it's called Google Translate. It's worse than Duolingo.
Oh my God! Honestly, Caroline Conan told us what street she was on, and you were just like, "Yeah, I'm not going to say that. It's not going to happen. Why are we even doing this?"
It's interesting, Lisa, because it's a time of autocracy. We saw it in Hungary.
Yeah,
now
exactly.
We see it in France.
How much does this really represent the new order versus a breaking point? Because people were saying that, frankly, the war in Ukraine had to do with a coalescing around NATO. Is that really an accurate rendition of where we are?
And as John would say, we'll have full team coverage April 24th.
I'm sure.
Futures negative 27. Market deteriorates a little bit. This is Bloomberg.
nuestro estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The Fed will be pushing on because the labor market is overheated and inflation is too high.
The Fed has to move ahead to control inflation.
It's really now for the market to catch up to the Fed.
The Fed needs to step in and needs to take some of the steam out of the labor market.
We can't ignore the longer-term risks of this consumer-led recession or slowdown, whatever it may be, that are building.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning. A pivotal week starts with a yield spike. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. Tom Keene, Jonathan Farrow, Lisa Abramowitz. John Farrow, Tom would say, is on sabbatical. I will say it's vacation. Kaylee Lyons is with us this morning, which we're very grateful for. And Tom, honestly, we've got CPI tomorrow. We've got the Q1 earnings kicking off on Wednesday, an ECB meeting on Thursday. How much is the scene setter really? 10-year yields rising to the highest going back to 2019.
All we've done is set the table this morning. The one thing maybe we've underplayed, Lisa, is that important inflation report tomorrow. And I'm sorry, there's a bunch of sub data. All you need to do is look at the headline data, 8.4%. I guess that's a boom nominal GDP for a while, but then what?
And where does it go, right? Is it headed upward? How much upward are we talking about? Or is this the plateau? Is this the peak? And that's why I think that, frankly, Wednesday's earnings kickoff may be more important to markets, given the forward look, than even the CPI report.
And there's a great division here, folks. I mean, it's real simple. There's people looking at a average 5% earnings growth, people underplaying that. Mike Wilson with a very cautious note over the weekend at Morgan Stanley, and others more optimistic about a resiliency, at least in certain sections of the market. Lisa, to me, it comes down to the apparent animal spirit, which is that big inflation plus some GDP. How big is that GDP?
And that's really what a lot of people are saying, which speaks exactly to the earnings. And Kaylee, how much are we going to see good news is good news versus good news is bad news? Because it means means a greater tightening and, frankly, a greater inflationary impulse that we need to constrain.
Right. If you're an equity investor, you'd like companies to be able to exercise pricing power, to retain margin, and therefore continue to post the kind of profits that we have seen. At the same time, we know that pricing power that companies are exhibiting has become problematic for the Federal Reserve. We've heard speaker after speaker talking about that because those prices are getting passed on to the American consumer, exacerbating the inflation that they are feeling. So is it a good news is bad news type of scenario, or would bad news then be good news if it means less aggression on the part of the central bank?
Yeah, and honestly, Tom, we've been talking about markets. Let's go there, given the fact that yields are really driving a lot of the action, and frankly, internationally, because you're seeing the same kind of move over in Europe that you're seeing in the U.S. with 2.75% 10-year.
Well, yields are there, 2.75%. And what really is the catch-up in the deterioration, if you will, in equities. Just in the last 20 minutes, futures are negative 28, Dow futures negative 113, and NASDAQ down 1 full percent right now. And the VIX out 22.79. A 23 print would be a big deal. We're not there yet. 22.79. The angst of the VIX as well. In the currency space, it's simple. Resilient dollar, and I'm watching yen, yen, yen. This is a little inside baseball, but the global Wall Street, weak yen is a bigger deal than you would normally think. 124, 125, and to get to a 126 print on weak yen this morning would be really quite something. That's on dollar yen. We're watching euro yen as well. Oil, that's part of the story, well under 100 on Brent, $98. West Texas down 5%, $93.49. On interest rates, on the guesstimate of yield up and price down, Said Lada joins us now, head of G10 rate strategy. Said, buried in your report is something over the weekend I saw numerous times, which is a constructive tone because pensions have to do something. They're out there and they have an appetite for bills, notes, and bonds. Is it pension plans to the rescue?
So indeed, and thank you, Tom, for having me. What we see is pension funds are in the best position they've been since the financial crisis of 2008. We have aggregate surplus for the 100 largest corporate pension funds in the region of 105%. So they are fully funded, better than fully funded, and there's no more a large cost to hedging the volatility on the balance sheet of their defined benefit pension funds. In terms of their appetite and possibility to support U.S. fixed income, we've seen that. We've seen an average of about 10 billion a quarter or 40 billion a year for the past few years of strong LDI activity, excluding 2020. But so far, all we've seen is about 6 billion this quarter. So March in particular was a little bit underwhelming in terms of LDI activity. That being said, I think you're right. We do expect pension demand to get back to that kind of run rate of 10 billion a quarter and 40 billion this year, which is indeed, I think, should help to cap the path of long end rates ultimately.
Yeah.
But their demand is really centered on the 20 and 30 year points.
Which really goes to the heart of a lot of the questions that people are asking, which is, do you lock in 2.75% 10-year yields for the long term right now? Because frankly, this will look good historically, at least according to many people. What is going on today, given that argument has been floating for a while? Is this simply worries about QT? Is this just basically people unwinding hedges?
Look, I think in terms of the construct of the Fed exit and actually the fiscal exit as well, all a part of the great unwind that we've talked about for being really this year's trade or playbook. This is part of it. So higher rates and a broad flattening of the curve is part of it. What we've seen up until quite recently is things like the 5-year, and 10-year rate have been somewhat low and depressed, consistent with a Fed dot that's below the Fed funds rate in 2 years, based on the last FOMC dots. So where we are now, I think, is in a pretty rapid and ongoing repricing in fixed income that we wouldn't wish to stand in front of, because markets can move away from fair value. But I think ultimately during the course of this year, and probably in a matter of months, we should find a level which may be closer to 3. which should find strong support for fixed income demand.
Shahid, obviously the market has rushed to reprice how many times the Federal Reserve will be hiking this year. It has to price QT as well. What does balance sheet runoff equate to in terms of a basis point move? If we've heard from Federal Reserve officials that essentially it's the equivalent of like a 25 basis point hike. How do you think about it?
Sure. Look, I think when you put this together with a bunch of factors, what you also see is that net supply, net of QE, is actually falling this year, and that's partly because it was so high last year, despite strong Fed QE. So really, we've got two forces. We've got the Fed and we've got the fiscal deficit, which is falling a lot. And so to some extent, I think that the Fed's numbers are sensible, but it is quite difficult to put a number on the duration impact down the curve. And the reason is because QE is an explicit purchase, but QT is an implicit sale. So it's really the Treasury and not the Fed that decide where that duration is ultimately supplied.
Saeed, thank you so much. Saeed Lada with us there with a somewhat constructive view on fixed income. Again, the headline 2.75% on the 10-year yield, deterioration on the tape as well with futures negative 30. Javier Blas out, Lisa, with a note, and he linked Shanghai and COVID directly to this 5% move in oil. West Texas, a 93 handle, Brent crude $2 under 100, and it's real simple. Shanghai shut down in other parts of China as well.
And this has been basically the big argument as to why you've seen such a big move in oil, not necessarily the release of the barrels from the petroleum reserve from the United States and other nations. This is the wrong reason, right? You don't want to see oil prices down if you're a bull on growth because of growth concerns. And yet, how much does this really show, frankly, the incredible volatility in oil prices? It trades like Bitcoin on a lot of speculation of what might be the influences. How do you even gauge out a longer-term view?
Well, I'm going to do a demand dynamic there as well, and maybe the safe haven basis, there's a little bit of instability. Gold up $21, Lisa. I mean, 1967 an ounce. The right word, I've used it too much, is cacophony this morning.
Especially given the fact that Bitcoin, since I know you love Bitcoin, and since John isn't here, Bitcoin is falling. It's the lowest since March 22nd. I love what people say as to why. They say, well,
why?
The
conference... It's because Kaylee's on the show.
Exactly. There was a big conference in Miami having to do with crypto assets, and it ended. And so people were saying the reason why Bitcoin is down is because, you know, the sugar rush is off and the parties are over, which
Lisa,
I find kind of hilarious.
Trying to out-cynic me on Bitcoin. Let's talk about our 3-hour effort, Crypto, with Kaylee Lyons. How's that going, Kaylee?
It's going great. 1 p.m. Tuesdays. Make sure you tune in. Shameless plug. We'll be talking to the FTX founder Sam Bankman-Fried tomorrow, so it's going to be interesting. But it raises, Bitcoin is related to the broader theme we are seeing in the markets, I will say, in that usually it trades in tandem with other risky assets and increasingly with technology, which is coming under pressure as we see real yields now sitting at just negative 13 basis points, Tom.
Lisa, what do I say? I mean, she's so drunk the Kool-Aid.
Well, a lot of people have, you know. I mean, this is the reason why I mentioned it was not just to get you annoyed, although it was a really good, it was a really good side effect. But it was because there is this feeling of what's the haven right now, right? If it was commodities, that was the big inflation trade, right? That was the hedge against inflation. Inflation is clearly still front and center. Now, what is it?
It's not the yen, I can tell you that much.
Yeah, exactly.
Well, let's talk about the yen, and that is a weak yen out to a 125.65. That bears close global Wall Street scrutiny, but even more, the inflation report. We'll dive into those headline data. We do that tomorrow on Bloomberg Radio, on Bloomberg Television. Stay with us as we look to Paris. Say Bloomberg.
Oh, dear Lord.
Keeping you up to date with news from around the world with the first word, I'm Rishka Gupta. Iran says the 2015 nuclear deal is alive, but lingering in the, quote, emergency room. A government spokesman says the deal's fate is resting on a decision by the U.S. on Iran's latest proposal. One of the issues is the Trump era's designation of Iran's Islamic Revolutionary Guard Corps as a terrorist group. In France, President Emmanuel Macron and nationalist Marine Le Pen are headed off for a runoff in the presidential election. It's a rerun of their 2017 contest that will reverberate across Europe. Macron received 27.6% of the vote in Sunday's first round. That's compared with 23.4% for Le Pen. The runoff will be on April the 24th. 3 polls show Macron leading Le Pen 54 to 46. Ukraine's President Volodymyr Zelensky expects Russia to turn to even more large-scale action this week in the eastern part of the country. He has been warning for days of a new Russian offensive. Zelensky told CBS he understands there will be much more Russian weaponry than there is now. And it is another twist in the week-long saga of Twitter and Elon Musk. Twitter says the world's richest person has decided not to join its board. That touched off renewed speculation about the company's future. Musk owns just over 9% of Twitter's stock. If he doesn't join the board, well, Musk wouldn't be subject to an agreement to keep his stake at no more than 14.9%. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Mariska Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The war in Ukraine rages on.
President Putin's invasion is brutal.
Turn to Bloomberg for up-to-the-minute reporting from around the world and analysis of what it all means to you.
The intention here is to increase the pressure on the sanctions front.
I think the United States policy is that the sanctions continue until President Putin is no longer there.
For continuing coverage from Ukraine and around the world, keep it tuned to Bloomberg Television and Radio.
I think that it will take some time to get inflation down because, as you know, there's other things going on in the economy that are adding to price pressures, including the commodity price increases and energy price increases that are happening as well. So I think inflation will remain above 2% this year and even next year, but the trajectory will be that it will be moving down.
Loretta Mester with Margaret Brennan there on Face the Nation CBS. You can hear Face the Nation on Bloomberg Radio, hugely popular. I believe that's Sunday afternoon at 2 p.m. The gentlelady from Cleveland there, the mathematician, away from transitory and looking at a persistence of inflation, and you see that in the market this morning. These are markets on the move as we speak. Lisa, help me out here. 2.76% with real deterioration at 23 VIX moments ago. Futures now negative 33. Lisa.
The idea that the 10-year yield, as it climbs, it is directly correlated to a further drop in stocks, and you're seeing a disproportionate increase in some of the volatility in tech stocks and crude. I really want to focus on crude, Tom.
Please.
The volatility has just been shocking. You talk about the VIX, but equity volatility has not been what has shocked a lot of people. It has been the fact that oil swings around as though it were a crypto asset these days. And it's the smallest thing right now. It's speculation that the shutdowns over in China are leading to fears of a lack of demand.
Over 2 cups of coffee, just to give you some scale, folks, the 10-year inflation-adjusted yield, that residual, has gone from negative 0.14 to negative 0.11. All of that in about 2 commercial breaks here. That's a big deal. The real yield spiking up. We are on the zero watch effective this morning with that CPI print tomorrow. On oil right now, Ellen Wall joins senior fellow at Atlantic Council and definitive as well on the Saudis. Ellen Wall, with the oil issues and with demand in China, what do the Saudis do?
The Saudis, I think, are actually in a somewhat difficult position at the moment with problems in terms of these lockdowns and potentially really could cut into demand in China, especially with Russian crude being available at such a discount for the Chinese. They may really need to make their products more competitive. So they do have long-term contracts with certain Chinese refineries, particularly the petrochemical and refineries that they themselves, that Aramco has stakes in. So they don't need to worry about that supply, but it's basically everything else on the margins that they're used to selling to the Chinese that they may need to make their products a little bit more competitive to compete with this cheap Russian oil. And we could see them offer a price cut.
Okay, well, they'll offer a price cut. Ellen, let's go to Wald 101. Is oil one price this morning, one global price, or not?
Well, it's never really one global price. We've got the benchmarks, and then we've got, the different blends that are sold based on those benchmarks. So Russian crude can, the Chinese can get this Russian crude for, it could be as much as $30 off of the Brent benchmark. And that's a really good deal for China. Even if they're experiencing a drop in demand, they could use this opportunity to put more into storage. So I'm not sure that we'll necessarily see fewer imports going into China if China thinks they can get a discount, but consumption in China could definitely go down, and that could hurt the independent refinery business, which does a lot of business making products and selling them around Asia. And And if there's no demand coming for these products from China and other areas, that could definitely hurt that sector in China.
Is there a historical corollary for this period in terms of uncertainty, in terms of volatility in oil price, in terms of the fact that we're asking the question, is there a global price for oil, or is it basically choose your own adventure?
Yeah, I really think that this is a very unprecedented period historically, because there is so much effect in terms of speculation and of all of these different prices going around in the market today. We used to, there were previous times when we had big oil incidents. We, remember the 1970s oil shocks. We had the Iranian Revolution. Those were all massive issues in the oil market, except that at that time, there wasn't this kind of financialization of the oil markets. You didn't have, traders trading oil every minute, or you didn't have algorithms that were acting on the market in mere seconds or even less than seconds. And all of this financialization introduces more volatility, and it makes any move much more, it makes it much more attenuated. So, we may see the effects of these Chinese lockdowns, but the fact that there's so much money and so much trading and so much attention to the oil market just makes these swings even larger and even more volatile.
Ellen, you mentioned there the Iranian Revolution. Let's talk about Iran in a different context. It's saying today that the 2015 nuclear deal is in the emergency room. It's not dead, but it's in the emergency room. What is your base case on whether or not a deal can ultimately be reached and how that will reflect in oil prices?
Yeah, this is I think a significant issue, particularly because several months ago there was a lot of optimism that we would get an Iran deal. I remember speaking with people who were very much in tune in the Iran analysis area, and they were very, very positive that a deal would get done before March. And now, looking at the situation, it's a different ballgame. And I do think that the incredible rise in oil prices and the war in Ukraine has given Iran an advantage, because they are still selling their oil and they're making much more money, and so that doesn't that reduces the pressure on them to come to the table and to make concessions.
Right.
So it's really created a situation in which Iran is in the driver's seat here.
Ellen Wald, thank you so much. On A Global View of Bond, can't say enough about her one volume on Saudi and the royalty. Just a superb effort on Saudi Arabia. Lisa, it will be a frenzy. A 7-part Amazon piece. They have 6.x% long-term debt. I mean, and with yields up a little bit, you got to believe, who's not going to buy this?
Well, exactly. At the same time, where are all the other companies going to try to lock in borrowing costs? Is this basically a bet that this is the peak of yields, or that, frankly, the yields are going to climb so much more than this that you better get in now before that happens? I mean, we have seen a lot of companies try to lock in the financing costs, and you have to wonder whether they see something down the line, whether it's how much people are willing to pay, whether it's the price increases that they're actually passing along, that they're saying, this is the time. Go.
Yeah, well, I'm looking at a present piece here, out 9 years, and the price was 105, and this morning you're joining it at 89.
Yeah.
So as John Templeton would say, bonds are on sale.
Yeah.
Go Amazon.
Well, bonds are on sale, but not in the right direction if you're an issuer, unless they're going to be even more on sale later on.
We will see. This is Bloomberg.
it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Bloomberg Savannah, so we say good morning to you with markets on the move. Futures negative 36, Dow futures negative 152, and the VIX solidly over at 23 right now. A nice tension. NASDAQ down 1.3% as well. Lisa, I got to go to oil with a 4% move down, and the redounding that Javier Blas was talking about off difficult COVID news in China.
Yeah, but it's just basically this knee-jerk reaction that on news, there are huge moves. And Ellen Wall talking about the financialization of oil markets. Are we seeing that? And frankly, are we seeing a remove from the rest of markets which are discounting some of that volatility as simply, oh yeah, that's commodities doing its thing again?
Part of our job on radio and TV is for Global Wall Street to give you the idea on corporate paper. Amazon, AA rated. Clearly, they could manage to a AAA if they put their mind to it. Lisa, 40-year paper, 2062, 150 beeps over Treasury. I mean, even Amazon has to pay a markup here, don't they?
Okay, so we were having this argument in the break. Are they trying to time the market, or is this simply them trying to raise money in a routine way? Because if you take a look at the 100-year debt that you own from Austria, it's not doing so hot, right? I mean, the longer-term bonds have been on sale. Is a kind way of putting it. I mean, they've been basically absolutely pummeled this year. So are they raising money because they think yields are going to go higher, because the yields are still low enough for them to see this as an opportunistic moment, or because they actually need the money, which is hard for me to believe?
Yes, very good. Kaylee, I can do this here. We're going to do this quickly. You can do this on the Bloomberg, folks. You can look up the piece of Austria I bought for the great-great-grandchildren and notice that you're down 58% in price from the beginning of the year because you're out 100 years. Neil Dutta with economic forecasts out 100 years joins us now, head of U.S. economic research at Renaissance Macro, and he has been a strident optimist through gloomy times. Neil, what does the Gloom crew get wrong on this Monday morning?
Well, first, I mean, I think it's important to recognize that the recession chatter is ubiquitous. I mean, it's everywhere. I think I was reading an article in The Economist talking about recession risk rising. Obviously, we're seeing a number of major sell-side research houses, mark up their expectations or probabilities for recession. But, my view is that the risk of recession is really no higher right now than it normally is. I mean, I still think we're more or less in this inflationary boom type of economy. And I think that's more or less going to persist, for the next 12 months. When I look at, what's going to drive the recession right now? I mean, we're talking about how homes aren't being built and how cars are not being built. So, I mean, what's really stretched? I mean, potentially durable goods consumption, but it's hard to see how that in and of itself is going to drive a recession, particularly at a time when consumers are still sort of flush with cash and seeing a very strong labor market, outlook.
So, Neil, we see a lot of calls for recession, but is that really what's being priced in? I mean, yes, we have seen some declines and we have seen some areas that have gotten really hit, but I also read just as many reports saying lean into cyclicals, go to retail, buy the dip. How much have we actually priced in pessimism?
I mean, if you look at most surveys of investor, sentiment, it's not exactly in a bullish zone. I mean, consumers, for example, the Conference Board does data on, do you think stock prices are going to go up over the next 12 months or down? And, more consumers are saying they're going to go down. So, I wouldn't say that there's optimism in the markets. I think that, sentiment around equities over the next year are pretty negative, frankly.
So how would you position this? I mean, the other way of looking at this is how aggressive should you get leaning into risk? And I know that we were, Tom framed this, and rightly so, is that you've been a bull, and frankly, you've been right. But then how much do you say, okay, well, then you need to buy everything that's beaten up. You need to go into the Russell 2000. You need to buy banks. I mean, where are you taking that optimism right now?
Well, I mean, it's a difficult situation because right now, interest rate, we're in a rising interest rate environment, and that's going to have a negative impact on, certain industries that constitute a very large weighting in the equity markets, like tech, right? I mean, so we're seeing that. I guess the way I'm thinking about it right now is really how much more room is there for the markets to price in a more aggressive Fed for this year? And I don't really think there's much more the markets can do. We're basically pricing in neutral by year end. It's hard to see the Fed getting more hawkish than that. They've signaled that they want to get up to neutral. And I think they'll do that, but the markets are already there. So perhaps that brings some reprieve in terms of the interest rate backdrop for the back half of the year. And maybe that provides some catalyst for some of these cyclical areas of the market. But I think looking beyond that, I still think that would probably be a trade you'd want to rent as opposed to own, because I do think that the markets fundamentally haven't gotten their heads around just how far the Fed is likely to go in this cycle. I don't think the terminal rate is going to be, 2 3/4%. I think it's going to be higher than that.
How high, Neil?
Why?
How high? How high do you think it's going to go?
I mean, right now I'll say higher. It's, I mean, this is one of these classic questions where you're like, what do you think the 10-year is going to do? I mean, I have no idea, but I think we haven't stopped. I mean, to the extent that markets are pricing in cuts in 23 and 24 because of some sort of recession risk, I think those cuts are going to get priced out. So I do think that there's probably some upside to the longer end of the yield curve here. I don't see why the terminal rate can't be 3.5 or 4. Nominal GDP, we're in a very strong nominal GDP environment, and consumers are flush with cash. They're sitting on a large pile of excess savings, and they have substantial room to absorb more normal levels of credit appetite. At the same time, we've seen basically China and potentially Europe slip into economic weakness this year. Do we really think that's going to be with us in 23 and 24? The U.S. economy is unlikely to go into a recession, with China and Europe probably reaccelerating in those years.
Neil, I got to interrupt the show. I think this is so important. You've just framed out, as Lisa notes, a terminal rate of 3.5 to 4%. 99.925% of radio and TV listeners worldwide would suggest that throws America into some form of stagflation, growth recession, or outright NBER recession. Are you saying it won't?
Well, I mean, I think what you're seeing, that may, but I think the issue is, where does the consensus think the terminal rate is? And, you know, to me, the consensus thinks the terminal rate is basically what, like 2.5%, right? I mean, that's why, so, you know, some of these parts of the curves are already inverted. I think that's frankly too low. So I think the markets underestimate the extent to which the Fed can go without breaking the economy. Productivity is slowly rising. The labor force participation rate is continuing to climb. That all means that the Fed can go longer without breaking the economy.
Neil, speaking of why the Fed will go as far as it goes, CPI data tomorrow, does it have any real bearing on the decisions that policymakers will make, at least come May?
No, the die is cast.
The die is cast. So then when does the data start to matter again? What would it take?
Well, I mean, I think that for me, I primarily view these questions around the labor market. And, you know, to me, it's about jobs, hours, and earnings. And when you look at the sum product of those three things, it's growing, you know, 8-9% at an annual rate, you know, so far this year. And eventually, that should slow. I mean, as, you know, participation rates climb, wages start to moderate, you won't see a strong jobs growth at low rates of unemployment. So maybe that starts to cool off somewhat. And that could take some pressure off of inflation, because obviously whatever doesn't go into quantity, whatever is not real, will just, the remaining will be inflation. So we have to see. But to me, it's really about the labor market. I don't think that's going to happen anytime soon, because I do think there's probably additional downside to the unemployment rate over the next several months. I mean, you're going to be in a situation where, you know, the Fed is probably going to mark down their estimates for unemployment. But I do think it's primarily about the labor markets.
On the subject of unemployment, the Fed thinks 3.5% is going to stay the case through 2023, even if it moves aggressively. Do you buy that argument?
No. No, I think they would have to go much more aggressively in order to keep the unemployment rate at that rate, at 3.5%. We'll probably be in the low threes by the end of the year. So, you know, either one of two things can happen, right? I mean, the Fed can basically pencil in more rate hikes in future years to make sure that the unemployment rate stays at 3.5%, or they don't change their estimates for rates and the unemployment rate continues to plunge.
Neil Dutta, a primer, thank you so much. Really appreciate that. Really important comments there, folks, as we try to frame out this odd thing called the terminal rate, which is sort of what is the view out there, and the timeline of out there can vary as much. Lisa, an important guest in the 9 o'clock hour.
Yeah, talking about the fundamental research. What does that mean at a time of such great geopolitical uncertainty? Dan Suzuki, Deputy Chief Investment Officer at Richard Bernstein Advisors, is going to be coming up on the open as I try to step in for someone who is not on sabbatical. He's simply on vacation, Jonathan Farrow. Just putting that out there, because people might think that he's taking the rest of the month off, which I'm sure he wants to. But honestly, it's going to be a fascinating moment given where yields are and given how high that terminal rate could be. Such an important point being made there by Neil Dutta.
And Lisa, you may get a pricing on Amazon here. This is a real vanilla deal. There's nothing fancy about it. What I see there from Robert Schiffman and others in Bloomberg Intelligence is fixed rate. I'm not sure if anything's callable at all. Amazon, amount of cash, rounded up, 100 billion. Apple, 200 billion. That's one of the great differentials there. And Lisa, total debt, Amazon now, 7.2%. Apple, heavily indebted, 4.1%.
Yeah, heavily indebted. But look, I mean, again, this goes back to why raise money now, right? I mean, if you think that yields are going higher from here, it actually makes sense. Lock in borrowing costs where they are now, even though they're a lot higher than where they were 2 months ago or even a month ago. But if you're trying to price the market and you think yields are going to head back down, it's not a great time to sell debt. So, I mean, it just goes to your whole Austrian 100-year piece.
Thank you. It's good to know that the Austrian piece
your grandchildren,
is down 58% since I loaded the boat out of the triple leveraged all cash fund. That worked out. 100-year duration will kill you. That's what I told Afterthought this weekend.
Yeah, especially
futures at negative 34. Stay with us. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. In France, President Emmanuel Macron's team is painting Nationalist Marine Le Pen as an ally of Vladimir Putin. Macron and Le Pen will square off April 24th in a runoff election. They were the top two vote getters in Sunday's first round. Le Pen has been playing down her previous support for Putin. 3 polls show Macron with an 8-point lead. And Bloomberg has learned that the European Union's top diplomat is urging member states to send weapons to Ukraine quickly. Josep Borrell told EU diplomats a decision is needed in days and not months. Ukraine is preparing for Russia to step up its military campaign in the eastern part of the country. And in Pakistan, lawmakers elected opposition leader Shehbaz Sharif to be prime minister. Sharif is replacing former cricket star Imran Khan, who was ousted after 4 years. Khan has called his ouster a US-backed regime change. He lost a no-confidence vote after a fallout with Pakistan's army over a range of issues. And China has approved the first batch of new video game licenses since July. Bloomberg's learned the regulators have distributed a list of approved titles to developers. Last August, China's far-reaching tech crackdown spread to online gaming. The government introduced measures capping playtime for minors and new requirements aimed at curbing addiction. And Amazon is a long way from launching its promised drone delivery service, despite spending more than $2 billion on it. A Bloomberg investigation reveals a program hurt by technical challenges, high turnovers, and safety concerns. A crash last year had regulators questioning the drone's airworthiness. Amazon says it expects these types of events to occur and applies what it's learned from each flight to improving safety going forward. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I'm here at the Delhi airport, and behind me you can see SpiceJet's 737 MAX aircraft. Chairman Ajay Singh earlier today said that Boeing is going to compensate compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
When you have a highly transmissible virus like the BA2 and you have pulling back on mitigation methods, at the same time there's waning immunity, we're going to see an uptick. What we're hoping happens, and I believe it will, is that you won't see a concomitant comparable increase in severity.
Good Dr. Fauci of Holy Cross, their director of National Institute of Allergy and Infectious Diseases on ABC, and it's good to hear from him. Still contentious, still debatable in this COVID. We'll get to that in a moment. We've got three things to do here. First of all, we're watching the Amazon deal. I want to make clear to all that I was looking at the prospectus on the break. That's what we do here. We're so boring. We so need to get a life. I was actually reading the prospectus of the 7-part bond deal on the break. Kaylee's looking at me like, you are such a nerd, Tom. And the answer is it's the usual. J.P. Morgan, Morgan Stanley, Goldman Sachs are the book runners. And no, they don't have a roadshow at a hotel with a lunch. They'll do this in 4 phone calls. And one of the phone calls will be to Kriti Gupta to see if she wants to load the boat on Amazon debt. Right now, she's looking at the inflation-adjusted yield. Kriti?
Yeah, we got to talk about the real yield, Tom, because you were just talking about in the last block, the idea of Amazon. Are they coming to market because they're expecting those borrowing costs to start to surge? And this is going to be an important point when we talk about just where real yields are headed as well as nominal yields. Last week, you saw some pretty steep moves in the bond market, as moves as much as 17 basis points in one day in the nominal yield. But it's the real yield that's catching a lot of people's eyes. We are 11 to 12 basis points is changing tick by tick away from a positive real yield. The implications of this are significant, not just for the stock market. When you talk about, does this mean stocks become less attractive as you start to get a real yield into the bond market, but it also has implications for financial conditions broadly. Remember, those conditions have not tightened as much as, say, the Fed wants it to, but if you start to see a positive real yield, that is viewed by many as a risk-off move. So then does that really kind of spur a more tighter financial conditions index? That's something we'll keep our eye on, Tom.
Very good. Thank you so much, Kriti Gupta. We're going to finish this hour strong with Dr. Sharfstein. Joshua Sharfstein, he's the Vice Dean of the Johns Hopkins Bloomberg School of Public Health. Mr. Bloomberg, with a nodding acquaintance of his TV and radio network, is, of course, a benefactor to his Johns Hopkins University. Dr. Sharfstein, is the China Omicron our Omicron? Is it the same bug we had?
I think it basically is. I think for all intents and purposes, it's extremely transmissible. And for people who are unvaccinated, or perhaps the vaccine's lost its effectiveness, if it were a weak vaccine initially, it could be quite deadly. So it's a very serious situation in China right now.
We got over it quickly here, I would suggest, as an amateur. Do you have the same optimism there?
Well, they're taking such extraordinary measures to keep it down that they really are not in a position to get over it that quickly, I think, unless they can manage to eliminate it entirely, which is going to be quite difficult. So in our country, it went through so quickly because it just burned through the population very fast. And we suffered from that. We had the highest hospitalizations that we've had through the whole pandemic and quite a large number of deaths. But on the other side of that, we have a lot of immunity right now, and that's probably helping us with the BA2 variant.
So how threatening does that mean that future variants that potentially could emerge out of outbreaks like that seen in China, how great a threat is that to the U.S. or other countries that have a high level of either immunization or naturalized immunity?
Really depends on the nature of the variant, because we're all worried about a variant that could escape our immune system's response or partially escape. And it really depends on the biology of the variant. The thing that drives variant production is the number of infections. There are not that many infections right now in China. The Chinese challenge is, for China, they've really got to figure out how to best protect their population in the way that they find acceptable, I guess. They're doing things that we would not, I think, find acceptable. But for us, really helping to get vaccination out to the countries that don't really have it yet.
Well, and as there are still high infection rates in other parts of the world, when can it actually move into the endemic phase? That still feels pandemic-esque to me.
Yeah, I don't think we're in a much better place in the world until we've seen high vaccination rates in as many countries as we possibly can get to. And right now, it looks like the vaccine supply is not as much the limiting factor as the infrastructure for vaccination, as well as some fundamental issues of acceptance. And you've got to invest money to explain to people the value of vaccine and to be able to get it to their local jurisdiction. And all that's extremely important. So I hope that Congress recognizes that and adds the money back in to the discussions of a new pandemic funding bill.
Dr. Sharfstein, too short of visits. Thank you so much for joining us with Johns Hopkins today. We'll have to do this longer next time. Kayla, we do have to pay attention to this deal. I don't know what the size is on the deal. I'm seeing $12 billion floated out, but I really want to focus on the scope and scale. And with so many of these larger companies that we talk about, Amazon's no different, Kaylee, on long-term debt. They have 116 gazillion out there and 16 gazillion is short-term debt. So if it's 10 or 8 or 12 or 15 billion, it really doesn't move the needle to me, Kaylee.
Well, we're talking about Amazon's debt level here. You also have to consider their cash level, and this is really true across the technology giants. The same case could be made for Apple. These are companies that don't necessarily need to borrow. They are just tapping capital markets because they can, and perhaps maybe, and this is a question mark, they think the cost to borrow will be higher in the future. We've seen Apple tap the debt markets time and again as well over the last year and change, Tom.
The one thing that's changed here off of Bezos over to Jesse is maybe they're talking about a little more share buyback. It's not our job to speculate about that. But, these are some of the things you can do when you bring in that kind of money. It'll be fascinating to see how the yield settles out to 40-year. I mean, I don't know, Kaylee, should I sell out the Austria paper and load the boat on the 40-year Amazon?
I don't know, Tom. I don't know if you should take investment advice from me. But I do think what's interesting here is that when we're talking about relative value of any asset at this point, that is a conversation that's starting to change. The 10-year real yield now just 13 basis points away from positive territory.
Yeah.
And we've heard so often for so long, Tina, there is no alternative. What happens, Tom, when the alternative starts to emerge?
Well, I would really emphasize, folks, that this is not a normal Monday. Yes, into the CPI report tomorrow, but far more, as Kaylee mentions, the residual here of the nominal yield, take away the inflation, you get that itty-bitty 10-year yield now on the edge of a positive, real yield on the edge of a positive. There's a lot of other stories out there, and I would look off to Bloomberg at the 4, even down 5%, Brent crude, 98.52, that's off China worries. But really, all of it, Kaylee, to me, redounds back to weak dollar-yen. This is something Global Wall Street looks at, but a 125 even to a 126 weak yen is a huge deal.
And a stronger dollar, the strongest since July 2020, really speaks, Tom, to the divergence we're seeing on monetary policy. A BOJ that's going nowhere and a Fed that's going somewhere quite quickly.
Now, stay with us through the day. There's a lot of interesting analysis to be done, and also, of course, watching Ukraine. Emery Horder at the White House this morning. 12 o'clock, Laura Rahm. Stay with us on radio, on television. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA.
Connection lost.
Considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York City, for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow. Right now, we are looking at a deteriorating tape as yields in the United States climb to the highest we've seen going back to 2019. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
With the big issue, surging bond yields rippling through global markets.
It's been an incredibly fast climb in yields.
Yields have climbed so quickly.
It's been a bad start to the week.
Demand for bonds is evaporating quickly.
You had a huge sell-off in the bond market.
When you look at what's happening in the bond market,
Bond markets have been punched in the nose a few times this past year by the Fed.
The speed is a problem for equities.
This job of orchestrating a soft landing.
The ever-elusive soft landing.
It's going to, I think, require some fancy footwork from the Fed.
Growth is slowing and financial conditions are tightening.
We have a period now where equities and fixed income are struggling.
The market sees a meaningful risk of a recession.
The Fed's path to this soft landing has narrowed.
It seems unlikely that we're going to be able to avoid a harder landing.
Joining us now to discuss Allspring's Margie Patel, Hightower's Patrick Fruzetti, and Dan Suzuki of RB Advisors. Margie, what's your sense as we look at all of these calls for a potential hard landing? Where do you push back? Where do you see the potential for yields to go?
Well, I think historically that's been absolutely right. The Fed has slammed on the brakes and precipitated a recession every time. So I'd like to think this time they've looked at the past and they understand they need to be much more gradual in their approach. And I think that we're seeing very aggressive talk out of the Fed governors and allowing the market to do its work for them to push up the rates in the market. While they actually have been very slow to react, we've had a small 25 basis point increase. So that says to me, I hope the Fed is going to be very gradual and not feel they have to overreact. And in fact, even as far as aggressively starting to sell down their portfolio is not quite as scary when you consider that this year the actual deficit, the amount of Fed Treasury financing we'll see, is actually going to decline. So that may well offset securities that they sell. So I'm hoping they will be, their talk will be much more aggressive than their actual actions.
Well, and Patrick, Markey brings up a really important point, which is how high should yields go, right? I mean, honestly, at what point are they restrictive? Do you think that we're there? Do you think that we've surpassed it? Or do you think that the risk at this point is for the Fed not to be aggressive enough, not for them to go too far?
Well, if history is any indicator, the Fed will likely raise rates until something breaks. Unfortunately, I think they should be a little bit more patient, but let's just look at what's going on in the market. I mean, clearly inflation and supply chain pressures are going to dominate this earnings season again. The consumer resilience theme is under scrutiny despite $2.5 trillion of excess savings and a tight labor market. I mean, just listen to what executives are saying early on. Macy's executives saying that, inflation is going to hamper consumer demand. Restoration Hardware, flagged some softening demand. Conagra, we even saw, truckload numbers a week ago down 9%. These are all going to have a real impact. And, if the Fed reacts much too aggressively, there's clearly some recessionary pressures. We're seeing it all around us today.
Dan, what's your view of whether the Fed has gotten too aggressive with its talk? I mean, to Margie's point, do you agree with that?
Well, I think the issue for the Fed is that they've been so late to the game that they're playing catch up. I mean, they've finally woken up to the realization that we have the highest inflation in 40 years. And so they've been behind the curve, and now they're trying to catch up to the curve. And that process is very rapid change for the markets to digest. But I think it's the right move because I think, we're at a point where we're seeing, secular inflation rising, and the Fed doesn't really have control of that. So if they don't rein in inflation and do so maybe even at the risk of potentially putting the economy into a recession, I think then we have a bigger problem on our hands. So I think it's the right thing, but it's not necessarily something that the market's going to like.
This has been a dramatic morning, and I really want to underscore that with the move in yields really driven by a rise in real yields. I'm looking right now at the real yield on the 10-year Treasury of negative 0.116%, which is the least negative going back to the heart of the pandemic, and yet we're still negative. David Bianco of DWS expecting these yields to weigh on equity markets, writing, quote, a real yield above zero means valuations for equities and all assets requiring reassessing. The next 5% move for the S&P 500 is likely to be down, given slowing earnings growth, elevated inflation, and numerous Fed hikes likely pressuring the price-to-earnings ratio. Dan, do you agree with that?
Yeah, first of all, Dave's an old friend of mine. We used to work together back in the day. He's incredibly intelligent, and I agree with him. I mean, he comes from a very, very strong valuation framework. And valuations tell you that if interest rates go down, valuations for stocks should come down. And I think that's right. And I think that, looking beyond that, you have this environment where profits growth is slowing and that rising, real yield is telling you that liquidity is tightening. And that's not a great combination for stocks. So if you think about what that means for markets, I think people should be less focused on the market per se and focused on what types of stocks are at risk and what types of stocks are actually better, positioned to withstand that. So I think what's most at risk is the more expensive stocks. Your interest rates go up, they're more vulnerable, but there's areas that benefit from that strong inflationary backdrop.
And we'll get to some of those potential stocks. Margie, I know that, for example, you've been much more bullish and you think that perhaps some of the gloom and doom has been a little bit overwrought. So what would your response be to people watching real yields climbing closer to zero and saying this is going to be the end, the death of the TINA trade?
Well, personally, I've never made money by focusing on the real yield because over cycles, it's bounced all the way around from a big positive to a big negative. But what I look at and what I see in the equity market is the equity market has reacted more to the more speculative parts of the market have come under pretty severe pressure. We've seen a real erosion in price-earnings ratios rather than declines in earnings, which says to me that a lot of parts of the economy are still in good shape, can still have good earnings growth for those sectors that don't have a severe erosion in their prospects through the price-earnings ratio, which really reflects the pressure that we've seen in interest rates. So the real economy looks pretty good, and I think there's enough liquidity to allow the economy to keep on expanding moderately. So I think by the end of the year, we'll see a big bounce back in equity valuations.
Patrick, where do you weigh in on this?
Yeah, sure. I think you don't have a change in leadership in the equity market without, some bear market action. I mean, look what's leading of late this year in the market: healthcare, utilities, energy. Look what's been getting hit: financials, industrials, semiconductors have come under pressure. The fundamental law of investing is uncertainty of the future, and I think we're going through this market rotation, change in leadership. I think that's very important in sort of trying to determine where to invest in the market. And as Dan said, there are things to invest in this market, but stepping back, buying the dip, buying an S&P index fund, that's not a recipe, I think, for positive returns over the foreseeable future.
And we're going to get into the granulars of what to buy and perhaps what to avoid. For now, we're going to stick on the macro with investors bracing for the latest read on inflation. Cleveland Fed President Loretta Mester saying it will take some time to tame surging prices.
I think inflation will remain above 2% this year and even next year, but the trajectory will be that it will be moving down. I'm optimistic that we'll be able to remove monetary policy accommodation and maintain good labor market conditions and the expansion.
A lot of Fed speak and a lot of hawkishness. For more, let's bring in Bloomberg's Michael McKee. Mike.
Well, Lisa, they used to call it the 11 o'clock song, the showstopper late in the program, but we're starting the week with one today. Tomorrow, with a consumer price index. It's the first major number of the week and one that everybody on Wall Street's going to watch, even though it'll have almost no impact on the Fed, because that case is already decided for May. We will also be hearing from Lael Brainerd. I put her name on the list to represent all the Fed because she was so seen as so hawkish last week. We'll see if she adds to that. And the rest is all kind of related. Mortgage applications, housing, is that affected by interest rates, PPI? We get import prices, more inflation data, and retail sales on Thursday. That's going to be an important day. It's also the day the ECB meets, and they've got a lot to figure out over there. And for those of you on Wall Street, you get the day off on Friday. But for those of you who have to track economic indicators, we've got a couple, and you may have to at least have your junior people in the office to do it. Now, in terms of CPI, it's the same old story. A lot of moving parts to this, but basically one of the things we're going to be watching is service and price inflation. That's the white lines, and goods price. That's the blue lines, and goods price inflation, which is the white lines. And as you can see, we bought a lot of goods, raised prices there. Service prices are starting to go up. Do goods prices start to go down? That would be a bit of a sign of moderation ahead. Other things we're going to be watching in terms of inflation in both the CPI and PPI. Do base effects start to show? Prices were really high in these months last year, and so there's a feeling that could trim inflation a little bit. Do we see a slower rate of increase in energy and food? Prices have come back down, particularly for oil, enough to make a difference. Probably not for March, but going forward. And then housing, I mentioned mortgage rates. Is housing beginning to slow? We've seen some cracks. And then in terms of retail sales and consumer sentiment, are consumers still really, really grumpy? And are they going to stop buying more stuff because they're paying more for gas? Those are questions we will know by the end of the week.
Yeah, Mike, are they grumpy, and are they actually doing something with that grumpiness and not buying as much? Thank you so much for that. We've been talking about what to buy amid the inflationary backdrop. And Patrick, you were talking about there are some things that you do see as being valuable. What are you exactly pinpointing?
Well, I think everyone should have some exposure in the energy market. I still continue to think there's going to be a lot of strength in that sector. Looking at the balance of the energy sector, I mean, it's roughly 4% of the S&P. So despite obviously increased earnings, it's barely made a dent in terms of the allocation to the overall market. I think that's important, and I think owning some precious metals. I mean, we're not gold bugs, but we've owned it for the last couple of years, and I think that's going to continue to move higher. It's a secular shift in commodities in the years ahead, and that's a big important theme of what we're playing.
Dan, are you leaning into this? A lot of people are saying commodities are the inflation hedge, or has that trade basically been overblown and perhaps become overly consensus?
Well, I think I think you want to be tactical. I think that we're big believers in there's a new secular story that's happening here. We're in a new paradigm, and I think that paradigm comes with higher inflation and higher interest rates. So I think that secular story is there, and we've been overweight all the major inflationary beneficiaries, including energy. But I think that you have to be a little bit nimble going forward. If profits continue to slow at some point, with oil prices and commodity prices where they are, the risk reward starts to change. So I think that we're secular bulls on the story, but we're mindful that the cyclical can sometimes overwhelm the secular story. So right now we like it. We want to be broad-based inflationary beneficiaries, but we are increasing on the other side, the defensive component of our portfolios, higher quality, more defensive and less economically sensitive areas. That's increasing share of our portfolio as well.
Margie Patel, Patrick Frizzetti, and Dan Suzuki are all sticking with us as we do watch the real yield. Just want to mention this. We're now at negative 0.11. We've been just watching a lesser negative real yield throughout the morning. Joining us now with a look at the stocks moving ahead of the opening bell, which is related to that real yield. Here is our own Abigail Doolittle.
It certainly is, Lisa, because we do, of course, have futures down pretty sharply at this point, down about 0.7%. And one of the big movers there, of course, Tesla, another twist in the Elon Musk story. We actually have a redhead crossing not so long ago saying that Musk may engage in talks with Twitter, including strategy and governance. This, of course, follows the news over the weekend that Elon Musk is not joining Twitter's board. He let them know this on April 9th, the day he was supposed to be joining. And as you know, Lisa, this does mean he can increase his stake above 15% or so. More to come, I'm sure, around Twitter and Elon Musk. Tesla, related to, of course, CEO Elon Musk. NIO warned of delivery delays due to COVID restriction delays. That is weighing on Tesla. NVIDIA also down sharply, down about 4% as Baird cuts to neutral on demand worries. Recent cancellation trends are concerned. And as you know, Lisa, oil is down about 4% below its 50-day moving average, telling you the near-term buyers are out. That is weighing on energy stocks, including Marathon Oil, tumbling in the pre-market.
Abigail, thank you so much. Coming up, the U.S. answering Ukraine's pleas for more weapons.
We went through every single one of their requests, priority by priority, and worked through a game plan. Some of that's been delivered, some of it's on the way, and some of it we're still working to source.
The conversation still coming up ahead as we do watch futures continue to deteriorate ahead of the open as yields continue to rise in the U.S., the highest level since 2019. From New York, this is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
A market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This particular general has a resume that includes a brutality against civilians in other theaters in Syria, and we can expect more of the same in this theater.
Russia refocusing its war effort in Ukraine with a new commander. Ukraine gearing up for the escalation, doubling down on its plea for more weapons.
Now another battle is coming, the battle for Donbass. And of course, we are preparing to it, working with our partners to get all necessary weapons and basically everything that one needs to win a battle.
Joining us now from Washington is Bloomberg's Anne-Marie Hordern. So a new general with potentially that much more brutal tactics focused on civilians in particular. Have we shifted gears in Washington or heard a shifted tone in terms of what constitutes an offensive weapon rather than just simply a defensive weapon, or whether it even matters when it comes to arming Ukraine?
It seems like right now Western leaders are trying the best they can to get as many weapons going to Ukraine. On Friday, you had Slovakia's government coming out, shipping some new weapons to Ukraine, and now then the president thanked the Slovakian government, and then on top of that said that they would put a Patriot missile system into Slovakia because they are moving their weapons there. So you do see a number of countries coalescing into meeting the Ukrainians' demands and asks. And what you heard from Dmytro Kuleba, Ukrainian foreign minister, is very similar to his message last week in Brussels, which is he came with 3 agenda items: weapons, weapons, weapons. There does seem to be a shift in Kiev that, yes, sanctions are important, but more than ever right now, we need weapons. And that is because Russia is regrouping, as you say, Lisa, to the east. They have this new general, Alexander Dvornikov. He was in Syria. He really helped turn the tide of Syria towards Assad. He's known as the, quote, butcher of Syria. He became a hero in Russia because of this. And before he was anointed this new general position, his work in Ukraine was in eastern and southern Ukraine. So he has a very strong control on what the Donbass looks like. And it does look like that is what Russia is going to be targeting.
Anne-Marie Hordern in Washington, thank you so much, and for all the reporting throughout the morning. Still with us, Margie Patel, Patrick Frizzetti, and Dan Suzuki, as we deal with what's been going on in Europe, the idea of how long this conflict could potentially simmer. Margie, from your perspective, how does this development really affect your calculus as you talk about being optimistic and seeing more upside momentum?
Well, I think one thing it shows you that because of the conflict in Ukraine, that we're really seeing a deceleration in growth in many areas of the world, Europe, obviously, but also in emerging markets. And even in the U.S., our growth is decelerating, which builds a case for me that inflation will peak and go down, and we won't see huge increases on the part of the Fed. As far as what we're looking at, we, like the healthcare sector, we actually in the industrial space have liked the defense companies for quite a while, because the feeling was that these companies were just going to never really grow again, that there wouldn't really be any need for their products. So we think there are some sectors here that still look pretty good regardless of what the Fed does in interest rates.
Patrick, from your perspective, looking at Europe, there was a lot of focus on France, on the elections there, and the idea that perhaps people were more concerned about their cost of living than perhaps rallying around NATO. Does that shape your view on Euro or anything with respect to investing in European equities?
Not necessarily in European equities. We've really avoided that area of late. But what it does indicate when people are more focused on their local election is, we're on this continued path of deglobalization, right? And it began really during COVID, and it's been accelerated now with the war in Ukraine. And so people are focused on much more domestic issues. And I think you'll see, the opportunities, particularly here in North America, with various onshoring plays. So those are areas we're looking at right now as well.
What about you, Dan? How have you sort of shifted around Europe, or you basically stayed away as stagflation really reigns the supreme concern?
Yeah, actually, we're relatively comfortable, with our European exposure at this point. It's, if you look at Europe, I mean, relative to the U.S., it's trading at a fire sale price relative to the U.S. So a lot of the bad news is in these stocks. Clearly, the growth story is the big issue with, what's happening in Russia, Ukraine, weighing on the region. But I think if you think about the main transmission mechanism for what's happening in Russia, Ukraine, to really hit the European economy, it's via commodity prices and inflation. So given our exposure and everything we talked about before about positioning portfolios, to really, benefit from inflation, we essentially have that negative risk scenario hedged out in our portfolio. So with that aside, we're actually pretty comfortable with the European, equity exposure that we have.
You buying European banks, Dan, just quickly?
We own broad Europe right now. But we're happy to own the banks, particularly those that are less exposed. But, we're not particularly, in love with their banks. I think the U.S. banks are much more well-capitalized and better positioned.
All right, well, we'll get into that more later. Marky Patel, Patrick Frissetti, and Dan Suzuki, you're all sticking with us. And coming up, the morning calls, and later from big tech to the financials we were just talking about. Rate-sensitive sectors in focus as the relentless rise in Treasury yields continues. Still not a lot of love in many of the financials. That conversation still ahead. We are seeing a bit of stasis in markets as we see the NASDAQ down much more than the S&P. The S&P deteriorating down 0.7% with 7 minutes to go. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. A look at markets. You are seeing the NASDAQ lead the declines down about 1.1%, and we are seeing the S&P down about 0.7%. Time now for our morning calls. A look at some of the analyst recommendations on Wall Street. First up, MKM Partners upgrading JetBlue to neutral. The analyst expecting upbeat commentary about demand during its upcoming earnings report. Next up, Baird downgrading NVIDIA to neutral. The analyst forecasting a slowdown in PC demand amid surging inflation. And finally, Citigroup upgrading Wells Fargo to a buy. The analyst highlighting its stellar balance sheet ahead of this week's earnings report. Coming up, more on the big banks kicking off earnings season, of course, on Wednesday, following their longest slump since 2018. That conversation coming up next. And looking right now at the banks, they are lower despite the increase in yields. And honestly, talking about the increase in yields, let's take a look at what we're seeing in the 10-year, because frankly, that's been leading the charge with the equities, particularly the NASDAQ. 2.75% on the 10-year. That is the highest rate in the United States going back to 2019. In Germany, you've got the highest yields on the 10-year going back to 2015. From New York, as we open the markets, this is Bloomberg.
Airport, and behind me you can see SpiceJet 737 MAX aircraft. Earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Ferro, about 30 seconds away from the start of trading. And what you are seeing is that risk-off field. The NASDAQ now down nearly 1.2%. Yes, this is because yields are higher. It is also because of the chip stocks in particular, not only with some of the supply chain disruptions and potential lack of demand, but also because of some of the rate sensitivity that you're seeing. Russell 2000, typically more indicative of growth, down only 0.3%, while the S&P is down 0.7%. Talking about those yields, taking a look at what we're seeing in the 10-year, it has risen to 2.75%. I remember when it was 1.75%, which was not that long ago. The euro gaining a little bit after that election. At least the first round in France showed that Macron did seem to be getting more support than some of the polls would suggest. And crude, watching this, down 4% as people look at what's going on in China with the lockdowns and the effect that that could have on slowing global growth. Joining us now with a look at some of the stocks moving at the opening bell, here is Abigail Doolittle.
Well, Lisa, certainly those rising yields pressuring stocks. We do have the stock indexes down on the open, as you just outlined. And let's take a look at some of the movers beneath the surface, one of them being Twitter. Well off of its pre-market lows, though, down about 2% at this point. And more recently, a headline came out that Elon Musk, despite the fact that, as we learned over the weekend, will not be joining the board, he can engage in talks with Twitter, including strategy and governance. In other words, discuss various options with the board. He can also increase his current 9.2% stake to above 15%. If he chooses to do so. So more out on this, I'm sure. Tesla related in a way because of course, the shared CEO, well, at least the CEO of Tesla, Elon Musk, down 4% right now. It down in sympathy with news out of NIO, warning of delivery delays due to COVID restrictions. And that, of course, is weighing also on Rivian Automotive, down about 3.2%. Then you were just noting oil down about 4%, Lisa, at its lowest in 6 weeks. And related to that slowdown in China, that's taking the energy sector with it. ExxonMobil down.
Abigail, thank you so much. Treasury is also extending their decline, sending yields on the 10-year to the highest level since March of 2019, as we've been talking about throughout the morning, and playing a major role in this equity market. Bloomberg's Kaylee Lyons joins us now with more. Kaylee.
Well, Lisa, those higher yields tilting this equity market in a decisively defensive direction. That was on full display last week, where your biggest outperformer on the week was the healthcare sector. Actually had a record week to a record high. And some of your other classic defenses, the likes of staples and utilities, also outperformed alongside energy, which we hear time and again is acting as some kind of hedge potentially in this environment. Meanwhile, at the bottom of the pile last week, all of your technology-heavy sectors, information technology down 4%, discretionary, which houses Tesla and Amazon, down 3.3%, and communications, which houses the likes of Alphabet, was lower as well. Put it all together, and technology stocks, as measured by the NASDAQ 100, have lost more than $1 trillion in market value in just the past 4 sessions. And that answer, of course, logically comes back to those higher yields as the reason why. Not just higher nominal yields, but importantly, higher real yields, stripping out inflation. That is now just about 11 basis points away from positive territory. And that dents the appeal of high multiple stocks like technology and growth in particular, which is why you see tech stocks and real yields going in opposite directions, which we saw on that chart there. But of course, it's not just a problem for tech. Really, equities in particular could be threatened by the idea that TINA maybe won't be the case anymore, that maybe there will be an alternative. One more comforting sign for the bond market, though, maybe for equities, is the fact that the yield curve is no longer inverted. Instead, the 10-year yield, once again, about 20 basis points above that of the 2-year. That, in theory, a steeper curve should help the financials, but of course, we'll wait for those results around the corner, Lisa.
Kaylee, thank you so much. So we'll get into financials just shortly here. Margie Patel, Patrick Frizzetti, and Dan Suzuki still with us, but I do want to get a sense of to buy or not to buy big tech. Margie, what's your view on that?
Well, I still like the technology sector, even the semiconductor sector, because I think they have long-term growth. The price you pay for that long-term growth is very short-term, high volatility periods like we have right now. Many of these companies are at reasonable PEs, not some of the very high PE stocks. We don't have those. And also many of them are cash flow machines and have very attractive competitive dividends. So we think for an investor who won't be bothered about short-term volatility, that looks pretty good. So we like tech. We think healthcare is good. And we also like certain parts of the industrial sector, defense, also capital goods, as well as some of the basic materials, which I think have completely restructured over the last decade and should have secular growth, unlike we've seen in previous periods.
Patrick, do you view the dip that we're seeing in big tech as a buying opportunity, or is this sector still inflated as a result of some of the Fed policies over the past 2 years?
Well, as I said earlier, this is a change in leadership in the market. So in a rising rate environment, I believe you want to be underweight tech and you want to be overweight, more sectors that have frankly been in a bear market for 8 to 10 years, like the metals and mining sector, energy, and on top of that, I still like utilities and healthcare. So no, I still think you should be underweight big tech in this environment because it is a true change in leadership. And we'll see how the Fed responds. Hopefully, they're a lot more decisive than Elon Musk in the coming months.
Dan, I got to say, as I hear people talk about big tech, I'm sympathetic as to why valuations could go down, and yet betting up against big tech has not been a winning bet over the past few years. Do you agree that this is a change in the leadership in the market, or do you think this actually is an area for actual value, considering the fact that a lot of people view this as the safer aspects of equities?
Absolutely, Lisa. I agree with Patrick. I think this is a true change in leadership, and it's no coincidence this is happening alongside at the same time that you're talking about this move in yields and this change in liquidity. I think you think about big cap tech. I mean, tech broadly, we think is still in the midst of a bubble, and I think that bubble, still has a lot further to go before it ceases to be a bubble. You think about the backdrop. This is not the right backdrop to be owning these types of stocks. I mean, yes, there are great companies, but there were great companies back in 2000 that people thought their leadership wasn't going away either. It's the price you're paying and separating the investment from the story. In an environment where profits are slowing, these sectors do tend to be historically cyclical. In an environment where liquidity is tightening, these have been the biggest beneficiaries of improving liquidity over the past decade, and their valuations, we know, are very, very elevated. So we would not be buyers here. I think the biggest risk to people's equity portfolios is that these parts of the market encompass the majority of the market. Just 5 stocks make up a quarter of the S&P 500. Just 3 sectors make up 50% of the S&P 500. There's no diversification in people's portfolios unless you actively put it in there, and that means reducing your concentration in these parts of the market.
Dan, before we move on to banks, I just want to get a sense of how much further there is to fall. You start using the B word, bubble, and people start thinking of something more catastrophic. And I'm looking at Microsoft shares, for example, down already this year, more than 13%. What kind of downside are we looking at, and in what specific areas of tech?
Well, I think it's very broad. I mean, you go back to 2000. Basically, I think there were 65 stocks in the S&P 500 in the tech sector back then. All but 4 of them underperformed, and typically they were down 60, 70, 80%. Even the future winners like Amazon were down 96%, right? So it's not necessarily that these are bad companies. I mean, these are like cash cow, these are industry leaders, but it's the price you're paying for them, because people essentially have extrapolated the last 10 years, not just in terms of price performance, but in terms of the growth that they're going to get, the profitability improvements that they're going to get. And I just don't see that happening going forward. So, in terms of downside, we're not sort of distressed investors doing, company by company investment, looking at their balance sheets to understand what the underlying asset values are. But if you think we are in a bubble, and typically when the bubbles collapse, they overshoot, what's a typical bubble down? It's not down the traditional 20, 30%. It's usually a lot more than that. And I think that's the risk that's for a lot of these, the bulk of these stocks in this group, even if that's only to be oversold and then becomes a buying opportunity later.
That's a really bold call, which we'll have to revisit later. 20 to 30% potentially more downside risk for tech stocks. Meanwhile, we are looking to earnings, in particular bank earnings. The big banks all reporting earnings starting on Wednesday with JP Morgan kicking it all off. First quarter results, we'll get a read. Bloomberg Sonali Basak has been parsing through the expectations. What are you looking for?
Lisa, there's an enormous amount of dispersion when it comes to expectations for bank earnings. So you look at JP Morgan, which will be the first to report on Wednesday morning. There's almost a $2 billion difference in what analysts believe that they will make in trading. Same goes for Goldman Sachs. So there's a lot of uncertainty in terms of rates trading, in terms of commodities, but overall there's an expectation that the pie will be down. So the question is, how much can they beat those expectations by? Lisa, I also want to point out here the loan outlook, because while there is an expectation that loans will grow, there are a lot of questions about what a flatter yield curve will mean for net interest margins moving forward and the sensitivity of these banks' balance sheets. When you look at Ken Usdin of Jefferies, for example, he believes that NII will be lifted to more than offset weak fees, higher provisions, and lower buybacks. But with that said, all of those 3 things will be major headwinds for the banks.
Sonali Basak, thank you so much. Patrick, you're talking about a change in leadership and some areas to buy. Are financials one of them?
Right now, look, I think that I would say no, because I don't think, as you just quoted there, that net interest income is going to offset all of the sort of record, deal revenue that these banks were able to get last year. So I think it's going to be challenging for the banking sector. Again, you don't have a very steep yield curve. I think that's going to be problematic. And let's be honest, there's all of these things point to a risk of recession, and you don't want to own banks going into a recession.
Margie, do you agree?
We're pretty lukewarm on the financial sector. We think a lot of the areas are commoditized, overcrowded, and we don't see growth in a lot of these areas. So we're not very negative. We just think there's better growth opportunities in many other sectors.
And I guess that there's a question, Margie, about why higher benchmark rates, why higher overnight rates aren't offsetting the potential risks to the outlook, especially if you don't necessarily have recession in your horizon. How do you push back on that? How do you basically say, look, it is, but it's not enough to offset that potential downside?
Well, I think when you look at the corporate sector, the fundamentals, they're really in very good shape. The investment grade companies have a lot of liquidity, lots of cash on their balance sheets, so they're really immune to pretty significant rate increases. And same thing even with high yield so-called junk bonds. Those companies also have a lot of liquidity on the balance sheets that they all raise when rates are very low. Amazon today is another example where they can't get enough of the really low rate, long duration money. So I think that says the corporate sector is really not dependent at all on what happens if rates go up more than we're thinking, but rather their fundamentals, which still look pretty good. So that's why we're still pretty positive. We think that companies have great balance sheets, positive cash flow, and the economy is still going to grow. So that's a pretty good backdrop, and it'll make the economy a little bit more immune to these rate increases than we've had in previous cycles, because we don't have any bubbles in any particular area like we've had in other market cycles.
Dan, what's your view on banks?
Yeah, we're pretty positive. I mean, we did trim back a little bit in the last few weeks, but I think we're overall still pretty positive. I think, right now, what's going to drive their business, the core bank business, is loan growth and the profitability of those loans. Clearly, the yield curve has signaled, less profitability of those loans. But now, as you've been noting, this morning, those may have bottomed and start to go up. And so actually, as investors start to price in a steepening yield curve, that's going to benefit them. And on the volume front, the volume of the loans, I think is the outlook is pretty good. I think the economy is still, improving here. I think we've come from this environment where there was no demand because everybody's sitting on tons of cash.
Yeah.
Well, now the demand for, needing loans and needing money is going up. So loan growth should be pretty good.
Yeah.
Profitability maybe starting to improve. I think that'll be okay.
Thank you so much to all of you. Unfortunately, we have to go. Marky Patel, Patrick Frizzetti, and Tan Suzuki. Really wonderful insights. Coming up, COVID continuing its spread throughout China.
Certainly, the lockdown in China is going to exacerbate the problems that we have in supply chain. So that is putting upward pressure on prices.
That conversation coming up next. From New York, this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali, masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Bloomberg.com webinars.
Certainly, the lockdown in China is going to exacerbate the problems that we have in supply chain. So that is putting upward pressure on prices, and certainly all the businesses that we talk to in my 4th district and elsewhere through the country are saying that, you know, we've pushed out when we think the supply chain issues are going to be resolved, right? So not this year, now it's next year.
COVID lockdowns simply adding to a growing list of headwinds for inflation in China. Neil Shearing of Capital Economics weighing in on the country's growth prospects.
With or without zero COVID, 5.5% isn't sustainable. You then isn't achievable. You then layer on everything that's happening with Omicron and zero COVID, and I think it makes it even more challenging. It's going to be quite difficult to move the needle on the Chinese economy over the coming months.
Back with us is our own Michael McKee. Mike, really hard for the Fed to assess all the potential risks.
Obviously hard for the Fed to assess, but imagine being the People's Bank of China. You look at the numbers overnight from China, and they were not good. PPI up by 8.3% on a year-over-year basis. That's stronger than had been forecast by economists. And PPI is the number that we generally look at to give us some sort of idea about industrial production in China. CPI, more consumer-oriented, obviously, is up 1.5% on the year. That's an increase that's more than anticipated. A lot of that has to do with the lockdowns. So even though PPI is down a little bit from its peak last month at 8.3%, still a lot. And it suggests that the economy is slowing down. As Neil just said, 5.5%, their target seems unattainable at this point. And economists have now, as you can see, been marking down Chinese growth all year. Now it's down to 5%. Could they get to a 4 handle? Well, it's beginning to look like that's possible because, according to some experts, they are losing control or have lost control over COVID cases in many big cities. Shanghai, 26,000 cases so far. And you can see that chart there all the way over on the left-hand side. That was the original Wuhan outbreak. And now you can see what's happening in China. They don't have the natural immunity built up in the U.S. and in Europe because we allowed COVID to go through the population. Their zero COVID policy means a lot of people are exposed and vulnerable. And they also have a problem with their vaccine not being as useful against the most recent variants. So, Lisa, a lot of questions about what's going to happen in China, and a lot of those are unanswerable about what that then means for the rest of the world, but we can imagine it means slowdown.
Yeah, and Michael McKee, thank you so much. This is certainly what you're seeing in the oil market, with crude touching a 6-week low, and this is as a result largely of the story that we're hearing over in China, or at least that's what a lot of people are saying. Crude traded on the NYMEX down now 4.6%. Brent trading just under $100, $98.33, down 4.3%. For more, let's bring in Bloomberg's Javier Blas. I've been struck by the incredible volatility, Javier, that we've seen in oil prices. Now it's being attributed to the potential slowdown resulting from the lockdowns in China. What do you make of that reasoning and, frankly, of how whipsaw the action has been in the crude market?
I think that China is certainly one of the factors, and perhaps the most important factor today. But let's not forget that there are also other 2 important factors weighing in oil prices. One is the release of the International Energy Agency strategic stocks combined with the U.S. SPR, which is going to put more than 1 million barrels into the market over the next 6 months. And also the fact that Russian oil, with difficulties but continues to flow into the international market, is finding buyers in Europe, but also finding buyers elsewhere, particularly in Asia, India, and China. And the combination of those 3 factors, lower demand in China, more supply coming from Russia than expected, and also the release of the SPR, is what really is driving prices down, which, as you say, has seen probably one of the largest swings ever in history, from almost $130 a barrel to less than 100 now.
I'm trying to understand this because a lot of people were talking about the tightness in the oil market, that as demand came back, as the world reopened, that we would start to see that tightness really affect the oil market more than anything with respect to Russia. Where did that narrative go, Javier?
I think that it's still there. I mean, we just have put quite a lot more oil into the market that we were not expecting. I mean, the release from the International Energy Agency reserves is huge. It's more than 1 million barrels a day of extra oil going there. And also the fact that the drop in Russian oil production and Russian oil exports is taking more than people anticipated. The International Energy Agency have anticipated by April we will lose 3 million barrels a day from Russia. It's looking like it's going to be closer to 1 million barrels a day, and that's making the difference.
So going forward, what do you think the swing is? Further on the upside or sort of further on the downside based on what you're hearing from analysts?
Analysts and consultants, oil traders seems to be bearish for the very short term, but let's not forget from now all the way until the summer, we are going to have increasing demand for driving and traveling around the world. Jet fuel looks very tight. Yeah. Diesel remains tight everywhere. So I think that perhaps for the next few weeks, couple of weeks, 3 weeks, we have a bit of weakness related to China, and then potentially we start to recover.
Javier Blas, thank you so much for being with us. Coming up, we've got the market-moving events that you need to be watching. That's next in our trading diary. Right now, we are watching yields climb, still hovering around the 2.75%. As Marky Patel mentioned, we are also watching that Amazon deal, including they are selling 40-year debt, setting a jumbo bond sale at a time of yields that are rising. Are they locking it in for potentially even higher yields ahead? From New York, this is Bloomberg.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This is Bloomberg Markets at the open. We are looking at basically stocks where they opened at 1.2% declines on the NASDAQ. I find that the most interesting because of those rate sensitivities, and then also the S&P down about 0.8%. Really, the yield story has been driving the day, and really people have been ignoring the fact that crude is down 4.4% to $93.98. Time now for the trading diary. What you need to be watching this week, President Biden speaking with India's Prime Minister Modi at 11 a.m. Eastern, followed by Chicago Fed President Charlie Evans later this afternoon. U.S. CPI coming out on Tuesday, plus we'll hear from Fed Governor Brainerd. JP Morgan kicking off Q1 earnings on Wednesday, Goldman Citi and Morgan Stanley on Thursday. And finally, an ECB rate decision. We are looking right now at markets that are trying to digest all of this, in particular the ECB. I gotta say, German 10-year yields rising to the highest levels going back to 2015 gets your attention. And we are also watching the real yield, which are climbing closer to zero in the United States. This was Countdown to the Open. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari-sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant